if things go terribly wrong. Tina, do you want to say a few words?
Hi, everyone. Welcome. I'm Tina Drum with the Colorado Plan Giving Roundtable. And as you can tell, I just remembered to hit record. So welcome, everyone. I'm going to be here in the background, paying attention and listening. If you have questions during the session, please put them in the chat. And if you have something that you need to talk to me about, just go ahead and direct message me. So I'll be here. Welcome. I'm as excited as you are to learn from Craig. I've sat through this session a couple times, but I learned something every time. And Amanda, thanks so much for sponsoring these sessions. You know, if we didn't have the sponsorship that we have, we couldn't do this type of thing. So thank you very much.
Okay, well, let me get started with a couple of preliminaries. One is, I think we are all just sick and tired of Zooms, and let me just acknowledge that up front. I don't know about you, my mind wanders at about the 20-minute mark, and by 45 minutes, I'm done. And we are asking you to sit here for 4 hours. The last time we did this in person, it was about a 5-hour session. And paradoxically, because of Zoom, we've created an 8-hour session over 2 days. But I did that for a couple of reasons. One is I want to be able to have extra time because I think it's better if we can maybe get into some dialogue and some conversation. So this is a bit restructured, and there are about 20 of us. So I think I hope we can actually get some conversation going. For your planning purposes, I want to be very disciplined about taking a break at the top of each hour, because I know how it is to sit there. And I don't know about you, I'm going to call the break and I'm going to blank my video, and I encourage you to too. And then 10 minutes later, we'll resume. The other thing that I struggled with how we should do is how to get to know one another. So I'm going to go ahead and take the chance that we can make it through this list of people, and you can just say a couple of sentences about yourself. So I'm going to model that, and then I'm going to call on you. The weird thing about Zoom is I see people in a different order than you do, so I'm just going to call on you as you appear on my screen. So I started in plan giving in 1977. It was about 6 years after the Tax Reform Act of '69, which created the modern world of plan giving. It was totally an accident. I was new in my career at the Claremont colleges. They needed somebody to learn about this stuff. It involved sitting in a windowless hotel room with a bunch of attorneys and getting lectured to for a week. And frankly, I was low man on the totem pole, so I got the short straw and had to go do that. It really changed my career to be able to talk to people about taxes and finances in addition to their charitable interests was just an epiphany for me. And I have so enjoyed being able to work in this field. I am absolutely convinced that we make this sound too complicated. And so part of what I'd like to do today and next week is convince you that it isn't that complicated. We can have regular conversations about this. I spent much of my career at the University of Minnesota and then Minnesota State, and then retired from California State just a couple of years ago, and took a detour in the midtime and went to work for the for-profit sector for about 7 or 8 years. But plan giving is my life, and I really love this stuff. I am in danger probably of telling you more than you want to know, but I'm really committed to helping you find the tools and the words to explain it to people easily. So let me stop there. I exceeded my self-imposed time limit. And I'm just going to call on you as you appear. Michelle, why don't you say a couple of words about yourself?
Hi, I'm Michelle Maldonado. I'm the Director of Development at Denver Kids. We passively participate in plan giving and want to actively participate.
Thank you. Grace, you're next up on my screen.
Hi, I'm Grace Andrews. I am up in the Vail Valley at Bright Future Foundation for Eagle County. We serve victims of domestic violence, sexual assault, human trafficking, and stalking. I'm not new to the plan giving role, but our organization is. And so we actually have a board strategic planning meeting tomorrow and expect really audacious goals about plan giving to come out of that. So just excited to have this opportunity at kind of the perfect time.
Good, thank you. Colleen?
Hi there, I'm Colleen Davis. I am the Director of Advancement for Vail Mountain School. Grace and I don't know each other, so we'll have to get together up here in the Vail Valley. We do not have a plan giving program here at VMS. I used to work for Georgetown University in DC and did a lot of plan giving there, but mainly through our plan giving department. I was a major gift officer, so don't know the ins and outs on the back end as much as I'd like to.
Good. Lee, unmute yourself and tell us.
Hi, I'm Leah Montera. I work for the University of Colorado, and I'm not new to plan giving, but I think a refresh is always nice. I have worked at Mayo Clinic and kind of around the CU system, so happy to be here. Thank you.
Oh, good. I moved to within the shadow of the Mayo Clinic just a couple of months ago, so greetings from Rochester.
Yeah.
Jan.
Good morning. I'm Jan Bonner. I'm with the Good Samaritan Medical Center Foundation up in Lafayette. I really don't have much experience at all in plan giving. We have some experts at SCL Health and our philanthropy team who are, but I really want to learn more to be able to do it at the local level and just feel like I've expanded my abilities some.
Good. Shawna, you're next up.
Hi, everybody. I'm Shawna English, and I'm the Director of Development for Colorado Horse Rescue, which is in Boulder County. And we are embarking on rolling out the first structured plan giving program for the nonprofit. And not having a plan giving officer, that would be me. So learning as much as I can about it.
Good. Betsy?
Good morning, everyone. I'm Betsy Hayes with Mount Evans Home Healthcare and Hospice. We are up here in the mountain community just outside of Denver. So we do all of the in-home healthcare and hospice care from Georgetown to Golden, across Evergreen to Conifer, and then up and down 285 Morrison, all the way out to Shawnee. We're the only ones that do it. I have a lot of experience in sales and marketing and fundraising and events, and plan giving is something that I'm just learning. And we launched our plan giving circle instead of a society. We're calling it a circle. And we just did that. And I need to get really great at the conversations in planned giving. So I look forward to this, Craig. Thanks.
Good. We'll help you do that today.
Thank you.
Anna.
Good morning, everyone. I'm the CEO of the Roy's First Humane Society in Grand Junction, Colorado, with the satellite location in Delta. And we just restructured our entire staff, including sort of our development department, and are about to embark on a $2 million capital campaign. And think it's very important that we have some really strong plan giving to go along with that.
Good. Thank you. Theresa, I may mispronounce it.
Theresa. Good morning, everybody. I'm Theresa. I work at Emergency Family Assistance Association up in Boulder. We provide safety net services to families in need. I'm on the development team. I've been on the development team for a couple years, but my role is shifting to do more work with our major donors. And with that, I'm going to be talking more with them about planned giving. We do have a planned giving program, but certainly would like to expand that. So I'm happy to be a part of the team to make that happen and learn more. So thanks for having this session today.
Good. Thank you. Jeanette.
Hi, I'm Jeanette Price with Hope West, which is a nonprofit hospice and palliative care, soon to be PACE program in Grand Junction, Colorado. We do as well, just like Betsy said, we cover quite a large area of Western Colorado. So we have everywhere all the way up from Meeker, all the way down to Montrose and Ouray, you know, that whole corridor. We cover all that with hospice care. I am the Assistant VP of Development here, and we are in the middle of a capital campaign. So planning on really working towards putting our legacy society be a forefront in 2022. So hoping to learn and do whatever I can to be better.
Okay, thanks. Grace, somehow you're back in my lineup, but I think we already met you, didn't we? Okay. Tidra.
Hi, my name is Tidra Robertson, and I'm with Jewish Family Service. So I come from a government background and lobbying and legal background. So I have a little bit of knowledge of plan giving from that perspective, but we are in the process of getting ready for our 150th anniversary. So we're really putting a renewed effort toward our planned giving.
Great, thank you. Anna?
I already went, sorry.
Sorry, I'm not sure, this is one of those Zoom things, right? And Claire?
Good morning, I'm Claire Tobin. I'm Leadership Giving Officer with Rocky Mountain Public Media. We're home of Rocky Mountain PBS, Kubo Jazz, and our new hip hop and R&B radio station, The Drop. We currently have a planned giving program, but we're really looking to enhance it as well as possibly roll out a rebrand for our Legacy Society. So really glad to be here today. Thank you so much.
Great, thank you. Zoom is trying to be helpful and it just reconfigured. I'm now looking at a 4x8 screen. So I think, Theresa, I think Megan, Carol, have we heard from you?
No, my name is Carol Bennis. I am the Executive Director with Child Safe Colorado in Fort Collins. I'm sorry, I don't have video. Video when I logged on, then now it's not detecting.
Okay.
Weird reason. I didn't want to log off and log on again. I'll wait till break. But I am trying to learn more about planned giving because by the end of this week, we're going to be receiving our first gift of stock, $50,000 in stock from a longtime donor. And so time that we organize around that gift to get started.
Excellent. By lunchtime today, you'll be an expert, so you'll be well equipped.
Fingers crossed. Yay. Thank you.
This is Megan. So I'm with the University of Colorado Anschutz Medical Campus, and I've been a development officer for quite a few years, but was on the annual giving side for a long time. CFR was another role that I participated in, and I've been on campus now 10 years, and they hired me in a corporate foundation role. And then a number of years ago, I switched over and have been doing solely individual giving now. And so, Craig, I did your workshop years ago, and it's just such a good foundation. It, provides so many great reminders, and I just thought I really wanted to do it again as a refresher, and it just helps me to bring that conversation to the table with so many of the individuals that I'm working with. So thanks to everyone. Good to see you.
Oh, good. Thank you, Megan. We'll try to overcome the limitations of this format.
Yeah.
I have just a couple of more I don't think we've heard from. Jill at Denver Christian School.
Hi, Jill, Denver Christian. Yes, I am the Director of Development and Alumni Relations. We're really infants in planned giving, but we are launching a Legacy Society this fall. We're excited about that. We just were gifted a house that's going on the market this week. And so all the proceeds are going to be going to us, and looking forward to that. So lots to learn. I'm a bit of a one-man shop. The head of school also works in development. And then we have a little bit of help with some support, but looking to grow development at Denver Christian for sure. And planned giving.
Okay. Alec Lindemann.
Yeah, hi, I'm Alec Lindemann with KBUT Community Radio in Crescent Butte, and we don't really have any sort of planned giving, plan, honestly, but it's something I've seen, larger community radio stations kind of get into, but I haven't been able to find a lot of information on. So I'm very excited. Thank you very much.
Good. Thanks, Alec. Erika.
Hello, I'm Erika Roybal. I'm with the University of Wyoming Foundation. I've been in my position for about a year, so I still consider myself to be a beginner. Before that, I was in annual giving though.
Thank you. And I think on the phone we have Denise Delgado. If you're not like driving across Wyoming or something, would you like to introduce yourself?
I wish I was driving across Wyoming. I'm just sitting in my office. So thanks for the introduction. I'm with Girls Inc. of Metro Denver. I've been here for about 1 year. We have a small development department, growing, but all fairly new individuals. So at the time, it feels like a development team of one. wearing multiple hats, plan giving included, and we don't have a formal plan. And I think we'd like to see even a segmented plan around steps around, bequests, which I think behave a little bit different than, stocks, and how donors may be different in those categories. So I would like really to explore our plan giving, but how to chunk out the different components, because I think each might have a separate action plan.
Good. I think we can help with that. All right. Thanks, everyone. Did I miss anyone? Does anyone want to revise and extend their remarks the way they do in the United States Congress? If not, let me share my screen. And you should now be seeing full screen, a title screen. So go ahead.
Great. Yeah,
Yes.
this is Mark Farrow. I'm on the phone. We'll be getting into my office in about 35, 40 minutes. Sorry, I had to take a run, but I'm with Epic Experience. We are a relatively small nonprofit supporting adult cancer survivorship. And I'll just say I'm a complete novice / virgin as far as the planned giving perspective goes. My role has been in business development in the corporate world, and have recently been hired by Epic.
Good. Great. Thank you, Mark. Sorry I missed you. All right. You ought to see the screen now. Let me say a couple of things about the materials. You should have a set of the slides and a text document. As a couple of people mentioned, I did write a book called Plan Giving in a Nutshell. It's about 2.5 years old now, and I keep waiting for Congress to do something before I do the next edition. So what you have is the updated text that will eventually be in the new edition, less whatever Congress does. The slides are keyed to the text, so you don't have the whole book, but you've got the stuff that we're going to cover. If you have questions as we go, type them in that chat box to all, and I'll try to keep an eye on that. I can do that fairly easily, and if I can just work the answer to your question in, that'll be good. If not, I intend to try to pause at various points and see what questions you have. And one of the things to remember about the questions is if you're wondering about something, chances are others are as well. And this session is being recorded, so your questions are really important. To the extent we can in this weird sort of electronic format, I really would like you to guide the presentation with your questions. So with that, let's jump into it. First of all, the overall outline, we stretched this over 2 days because it seemed inhumane to ask you to sit still for 8 hours of Zoom. Today, we're going to cover parts 1 and 2. We'll spend most of our time on part 1. Part 1 is the tax fundamentals. We're going to talk about income taxes and estate taxes and the charitable deduction, and some about the donor nuts and bolts. So that gift of stock that you're going to be accepting later this week. There are some rules that we want to make sure we understand. Our goal throughout all of that is to focus on the after-tax cost of making a gift. I am not at all convinced that people make gifts to save money. But if we can point out to them the tax savings that are available, I think it makes it easier for them to make a gift. That's been my experience. I start with the tax fundamentals for a couple of reasons. One is they're fundamental. They underlie so much of everything else that we need to talk about. The other is I think most people start to get bored right away when you say the word taxes, so we might as well get that out of the way to begin with. And I'm convinced taxes aren't boring at all. They're actually a very interesting commentary. So we'll probably spend the majority of our time today on that, but I also want to cover part 2. And part 2 is some of the specific rules for the types of assets. We tend to think about charitable gifts in terms of cash only, and that's a big mistake because, as you'll see in a few minutes, cash is the smallest part of what people own. There are all sorts of other things that they could give us. That make great gifts, and there are tax advantages and challenges with each of them. We'll talk in some detail about stocks and bonds and mutual funds. Probably most of the non-cash gifts that we get will be securities like that. We'll cover a little bit about appraisals. There are some very specific rules, but they're not all that complicated, and we'll make sure that you understand the 3 or 4 major points. I want to touch on real estate. Somebody mentioned receiving a house. There are great opportunities in real estate and some cautions. And then I want to talk just a little bit about personal property and ordinary income property. There are a couple of tricks there that we want to make sure that we understand. If it all goes according to plan, we'll be coming up on noon when we finish that. Next week then, when we get together on the 17th, we'll start in with part 3. Part 3 is the basic plan giving methods. So charitable bequests, qualified retirement plans, life insurance, donor advised funds. Almost paradoxically, charitable bequests will be the vast majority of plan gifts that you ever entertain, and we'll spend only a few minutes on that. It's easy. It's not difficult, and everybody ought to do it. But there's so much more interesting material to cover when we get into some of these other areas. And then late next week, the second half of next week, we'll get into really the most fun you can have. And naturally, I notice a typo right there. Advanced should be capitalized. We'll talk about life income gifts, charitable gift annuities, charitable remainder trusts. These wonderful gifts that allow people to make a gift now and get an income back as a result of having made that gift. And there are tax advantages to doing that. I want to touch also on lead trusts. Lead trusts are very rare, but tend to be very large, come from very wealthy people, and really are vehicles to save on estate taxes. And then the last one I want to end up on, and this is my favorite, is the retained life estate. Retained life estate is a way for an individual to give your organization her home or her farm, but continue to use it for the rest of her lifetime. She gets an income tax deduction for doing that. Your organization is assured of having that property at the end. And it's a fascinating gift that really I think is used far too infrequently. So with that as the layout, here's where we're going to start. And this starts on page 4 of that text handout that you have. And it's the first dozen or dozen and a half pages. I want to cover, as I said, the after-tax cost of giving. Simple equation, but I think we forget this far too frequently. Then we'll talk about the income tax. 2 key concepts we want to make sure we have nailed down. One is the difference between effective and marginal tax rates. So people are fond of saying, I pay 28% or 24% now in federal taxes. Well, they don't. Very few people actually do. They may pay 24% on the last dollar that they earned. That's their marginal tax rate. But effectively, they're not paying that much. I want to cover the capital gains tax. Capital gains tax is, for our purposes, the tax that you pay on the profit when you sell an investment. So if you sell an investment for more than you paid for it, you're going to pay a capital gains tax on that. Capital gains tax is effectively half the ordinary income tax rate, but capital gains tax savings are available to all of our donors, whether they itemize or not. So it's important, especially these days, for us to be able to explain to donors how that whole capital gains thing works. And we'll look at an example that compares a gift of capital appreciated property versus cash. I want to spend some time on nuts and bolts. There are several things for us to know just so that we don't lead our donors astray. So we've got to talk a little bit about documenting the deduction, about our responsibilities for acknowledging, about where the donor's responsibility begins. I want to talk a little bit about date of gift, which isn't an issue this time of year, but sure will be come December. So we'll make sure that we go through some of those issues. Then we're going to turn our attention, probably fairly briefly again, to the transfer tax. You might recognize the transfer tax as the gift tax or the estate tax, or sometimes the death tax. It's very different than the income tax. This is a tax that I pay when I give something of value to another individual. And at least theoretically, anytime I give something of value to another individual, there is a tax, and I pay that tax. You, the recipient, don't. But as we'll see, The transfer tax these days only affects about 0.1% of all taxpayers. It has really been narrowed down, but it is a tax that is greater than the income tax when it does strike. And then lastly, I want to talk just a little bit about split interest gifts. So the life income gifts, charitable remainder trusts, gift annuities, the donor is not giving us that gift free and clear. They're making a gift to us, but they're retaining the right to income. So it's a split interest, and we need to make sure that we understand how that deduction works. You get a deduction for what you gave, that's the remainder interest, but you don't get a deduction for what you retained, that's the income interest. So in a nutshell, that's our first part of the day today. Beginning on page 4, we start to talk about the federal tax system. And as I said, the income tax applies to all earned income. So any income that you get from whatever source is legally subject to the income tax. As we'll see, many people can avoid taxes on quite a bit of that income, but you should at least report it. And this includes wages and salary and 1099 income and fees. Anytime you collect income, you really ought to stop and consider, do I owe an income tax on this? And then the capital gains tax, we'll get into some more detail, but as I said, that for our purposes is essentially the tax on investment profit. And then the federal transfer tax system, it's the same tax system. It's an estate tax if it's a transfer at death. It's a gift tax if it's a transfer during lifetime. And we'll pull that apart a little bit. There are some important differences, and there are advantages sometimes to making that a transfer on death. And when we get there, I'll just touch on some of the current political debate about the difference between the gift tax and the estate tax. So let me dig in there, and remember to use that chat box because I'm going to glance at it every so often. On page 5, there's a little bit of a discussion about this notion of the after-tax cost of a gift. So if you start out with the value that someone contributed, they gave us $10,000, and you subtract from that the taxes that they either saved or avoided paying as a result of that gift, the remainder is the cost of giving. The example we'll look at in a few minutes from now, if I gave $10,000 and as a result of the tax deduction, I saved $2,400 in income taxes, my cost of giving is actually $7,600. One of the reasons I think this is important is we have an opportunity here to go back to a donor and say, you were considering a gift of $10,000 and we're really grateful for that. Your gift is only costing you something less than that. And so perhaps you could see your way clear to make a larger gift, because after tax considerations, you'll still be making that $10,000 contribution. And so my conversation with the donor might be something like, thank you very much for your generous gift. You know, to really do that program up right, we could do it so much better with $12,000. And so let me show you some tax savings that might make it possible for you to make a bigger gift than you thought possible. I think that's why the after-tax cost of gift is worthwhile and important. And I'm convinced, it's been my experience, we can have this conversation without becoming an accountant or a financial advisor. That's not our role. But our role really is to help people figure out ways to make the greatest gift that they thought, or the greatest gift possible, whether that's larger or easier for them. This notion of the after-tax cost of giving, I think, really helps. On page 6, and now we're transitioning into the tax concepts. We need to understand taxable income. So people frequently talk about their income and they throw numbers around, and you're never quite sure what they're talking about. This was a lot easier back in the day when people used a paper form 1040, because each year you had to fill it out and you saw how it all breaks out. On the table on page 6 will show you, and I'll walk through here. The calculation is not that difficult. We start out with gross income. Gross income is everything that you've earned from whatever source, wages, as I said, consulting income, fees, dividends, interest. It all goes into gross income. Then you're allowed to subtract certain adjustments to income. So adjustments to income, the concept behind those is they were put into tax law because they're generally things over which you didn't have much discretion. The best example, although it was changed by the 2017 Tax Act, the best example was alimony payments. Court says you have to pay alimony. Well, that's an adjustment to income because you didn't have any choice. You simply didn't get to enjoy that income. So there are adjustments to income which are subtracted from adjusted gross income or from income to arrive at adjusted gross income, or AGI. You will see that term AGI shows up several places in tax law. It becomes the base for certain other taxes. We'll talk in a few minutes. It becomes the base for the ceiling on the charitable deduction. So adjusted gross income is essentially gross income minus amounts that you never had the opportunity to enjoy in the first place. Then, and here's where the law became less favorable, frankly, to the charitable deduction, then you are allowed to deduct certain items. Deductions were created in tax law generally to either incent or discourage certain behaviors. So one example is, as a matter of public policy, we think it's a good idea for people to own their own home. So we allow you to deduct from your income the amount that you spend on mortgage mortgage interest on a primary residence. The charitable deduction is another itemized deduction. We think it's a good idea for people to make charitable gifts. So we allow them to deduct amounts that they give for charitable gifts, all with the idea that it's reducing the amount of tax. You're essentially using pre-tax dollars to pay these expenses. About 50 years ago now, though, in the name of simplification, we created the standard deduction. And the standard deduction is an amount that you get to deduct, even if you don't itemize, even if you don't need any documentation. So for 2021, you can see the numbers on the slide. For 2021, if you're a married couple filing jointly, you get to deduct $25,100 from your income, from your adjusted gross income. You don't have to have any receipts. It doesn't even have to be real. You're just entitled to that standard deduction. The way it works is, if you have itemized deductions, you should total those up. And if the total of your itemized deductions is more than $25,100, you would take your itemized deductions because that reduces your income even more. But if your total of itemized deductions is less than $25,100, then you can just take the $25,100. Two things to note. One is the charitable deduction is an itemized deduction. So if you claim the standard deduction, you're not going to get any advantage from your charitable deduction. It doesn't matter because your standard deduction is larger. The other issue to remember is the Tax Cut and Jobs Act of 2017 changed the standard deduction. It essentially doubled the standard deduction amount. So prior to 2018, the first year under the 2017 Act, prior to 2018, these amounts were essentially 1/2. So a much greater number of people in 2018 were able to itemize their in 2017, were able to itemize their deductions than after the Tax Act. Just a side note, and it's in one of the footnotes in your handout, all of this changes back in 2025 unless Congress acts. So in 2025, we could see a great disruption. But carrying on, those amounts, $25,100 for a married couple filing jointly, or half that amount, $12,550 for singles, those are adjusted for inflation each year. So those are the amounts for 2021. So we start out with gross income. We're allowed some adjustments to income, things that we didn't really have much control over. Then we take our deductions, either standard or itemized, and that gets us to our taxable income. So taxable income is always going to be less than gross income. And taxable income is the number that really matters because that's what we pay taxes on. And again, if I'm talking too fast or said something that didn't make sense to you, feel free to type it in the chat box there. And be sure to send it to all, not just people that you want to tell jokes to. So now let's move on. And on page 6, you'll find a couple of tables that I'll be referring to. We have graduated and progressive tax rates in our country. We have had since the start of the income tax system. The idea really is that if you are in a higher income bracket, you, first of all, can probably afford to pay more in taxes than someone in a lower income bracket. And secondly, there's a sort of a philosophical presumption that you have benefited to a greater extent from our society than others, and so you should pay a little bit larger share. Our tax rates, as I said, are progressive. Keep in mind that they apply to taxable income. The rates right now range from 10%, so the least you can pay is 10%, up to 37%. There's a long history of changing those brackets. They have been adjusted over the years. That 37% number is not the lowest that it's ever been, but it's a pretty low top rate. For a great many years, the top rate was 70%. When I started in plan giving, the top rate had just been decreased from 70% to 50%. During World War II, we actually had a 92% top income tax rate. It was this curious idea that we ought to pay for the war while we were fighting it rather than borrowing money to fight the war. And so we had a 92% income tax rate during World War II to pay for the costs of the war. And the world didn't end. There were relatively few people who paid that amount, but that was the rate. The point to remember here is the effective rate is always less than the marginal rate. And I'll illustrate in a minute how that works out. Here's the key point for us. If you agree to make a charitable gift and you reduce your taxable income with that charitable deduction, you are going to save taxes at that top rate, at your marginal rate. It's not averaged over all of your income. You are reducing last taxable dollar and you're saving taxes at that top rate. So let me move on and show you what those rates are and then show you how that progressive thing works. So here are the rates. And just for clarity's sake, I wanted you to have both. There are different brackets for single versus married filing jointly, but let's focus on married filing jointly. On the first dollar, and I apologize, there's a typo there too. There are actually 2 more typos in the slide deck. I'm going to tell you about one of them, but there's another one I'm not going to tell you about, so pay attention. Of course, the bracket starts at $1. On the first dollar that you earn, the first dollar of taxable income, you pay 10%. If you're a married couple filing jointly, you pay 10% on every taxable dollar up to $19,900. If you earn $1 more than $19,900, then you'll pay 12%. You pay 12 cents on that one more dollar. That 12% bracket goes up to a little over $81,000. There's a 22% bracket then you start paying 22% on dollars 81,051 all the way up to 172,750. Then you hit the 24% bracket. The 24% bracket takes us up to 329,850. I would wager to say for most of our donors, they're probably in that 24% bracket. They're not necessarily wealthy, but they're doing well enough that they can consider making generous contributions. So you'll see in some of the examples that we'll use over the next couple of sessions, I use 24% because that's probably the broadest bracket that applies to most prospects. There is a 32% bracket. It's not a very wide bracket. And there's a lot of history that I won't go into as to why these brackets are the way they are. They have been adjusted and tinkered with over the years, and there isn't any rhyme or reason to them. 32% takes us up to almost 419,000. You make a few more dollars, those are taxed at 35%. And in 2021, if you're fortunate enough to have taxable income greater than 628,300, you will pay 37% on the rest. We talk about the 1% in our society. It's the 1% who pay that 37% rate. So one more table, and just because we love complexity in tax law, these brackets get adjusted for inflation each year. And as you'll see in one of the footnotes, this is all Tax Cut and Jobs Act of 2017 stuff, which will be repealed in 2025 unless they do something different. So in 2025, come 2026, unless they do something different, this will all roll back to pre-2018 brackets and rates. When Congress did that, the idea was certainly we'll fix that before 2025 rolls around. 2025 is breathing down our necks now. And as you can see, Congress doesn't exactly have its act together yet. So it's going to be very interesting to see. So those are the tax brackets and rates for 2021. Before I pause a minute and put you on the spot to ask questions out loud, because you're not doing that well in the chat box here. Either that or I'm just being that clear this morning. Let's look at an example. And this table, I think, is on page 7 for you. So to try to illustrate this, to try to bring it home, I said, let's pretend that we have a married couple filing jointly. They happen to have taxable income of exactly $200,000. Their gross income is some number bigger than that. They've got some adjustments, they've got some deductions, probably itemized in their case, but maybe it's the standard deduction. And when they do that subtraction, gross income minus adjustments minus deductions, turns out their taxable income is exactly $200,000. Here's how we figure out how much they owe in taxes. On the first $19,900, they owe 10%. So we add $1,990 to their tax bill. On the next $61,150, they owe 12%. 12% of $61,150 is $73.38. We add that to their tab. On the next $91,700, they owe 22%. That adds another little over $20,000 to their tax bill. And then on the last $27,250, they owe 24%. So they're going to pay $6,500 on that last bit of money. In the end, they're paying taxes on $200,000 in taxable income. Their total tax due, the sum in the right-hand column, is $36,000. So my question is, what is their tax rate? Well, the answer is two different tax rates. Their marginal tax rate is 24%. That's what they paid on the last dollar that they earned. But their effective tax rate is really only 18%. If you divide $36,000, their total tax bill, by $200,000, their total taxable income, they're paying about 18%. I am not encouraging you to get into an argument with your donors about whether or not their tax rate is high enough. That's a no-win argument. But it is important to remember they're not paying 24% on every dollar that they earn. Far from it. Their gross income was some number bigger than $200,000. The key point for us is if this couple makes a gift of $10,000 and gets a charitable deduction, they will reduce their taxable income in that last bracket. That number 27,250 will become 17,250. They will save $2,400 in income taxes. That's why it's important to be able to explain to people the after-tax cost of a gift. So let me pause there and see if anybody wants to be the courageous soul to ask a question.
Greg, this is Denise from Girls Inc. I'll jump in here.
Yes.
I'm just trying to follow along. So this model is for an existing major donor and in a general just cash gift. This has nothing to do with whether or not they want to donate some sort of donation outside of a cash gift. This is just how to talk better to our existing major donors so that we can potentially help them make larger gifts. Or am I trying to talk to them about like donate your stock and see what you can do?
Well, I appreciate your eagerness. I haven't quite gotten to how the gift works yet. I'm just using this as an example of how they figure out what their taxes are.
Gotcha.
And my point is, if we can give them a $1 of deduction, if we can reduce their taxable income by $1, it saves them 24 cents. Okay.
Yep.
Hey,
Theresa?
This is Theresa. I have a question. When you just gave that last example of if they gave a $10,000 charitable gift, it would reduce that 27,000 down to 17. But that would only be if they exceeded the standard deduction rate.
Right, because if they let's say they had no other itemized deductions and they made a $10,000 contribution, then they'd have $10,000 in itemized deductions and $25,000 in standard deductions. So they'd take the standard deduction. Fundamentally, they would receive no benefit from the charitable deduction.
Okay.
And I think that'll make more sense. We've got a couple of more ingredients to add to this, but I think it'll make more sense in a minute when we look at a gift of stock versus a gift of cash side by side.
Perfect. Thank you.
Mm-hmm.
Craig, this is Tina. Did you see Betsy Hayes's question in the chat? I can read it to you.
Yes, no, I see it.
Okay.
So Betsy's asking, do I go through their tax returns? No. And actually, if they started breaking out their tax returns, I'd get a little nervous because I'm not their accountant. I need to be able to explain to them how this works and then encourage them to work with their advisor, with their tax preparer, with their financial planner. What I do fairly fearlessly is use an example like this. And I say, for example, if you happen to be in the 24% marginal rate, that would mean that your taxable income is well over $100,000 a year. Here's how this could save you taxes, and you really ought to talk to your financial advisor and see how that could work for you. My job is to suggest the ideas, but I do think we need to be very careful that my job is not to help them figure out how to complete their tax return. And Betsy, if that's not responsive, just speak up and let me know.
Yeah, so thank you. This is Betsy. And so, yeah, I mean, I'm just thinking about my own taxes. I have so many things that I am looking to see if I can deduct, whether it's child credit or college credits or, am I getting to that 25,000? But when you're talking about calculating all of this to get to the marginal tax rate, I understand what you're saying, but because I don't have the experience of sitting with a donor and talking to them, like I'm not actually going to go through this stuff with them. This is just for our basic knowledge for background, correct?
Yes, that's right. I want you to be able to confidently say, I know that you pay more on the last dollar that you earned than the first dollar that you earned. And I'm not proposing that we do a primer on progressive tax rates.
Yeah, no, I mean, our job is to educate, not advise. So
yes.
I have that in big words in my office. Every time I pick up the phone, I look at it just to make sure I don't step over the line. So that's why I just want to make sure I understand where you're going with the presentation.
Yeah, I think that's right. I mean, and I may regret saying this. Part of my goal here, these two sessions, is to encourage you to bluff just a little bit. Because sometimes we tend to say, oh, that's too complicated. I don't even know anything about that. Well, go ahead and explain to them, tax rates are progressive. That means the more you make, the more you pay. And the reverse is true as well. The more you give, the more you save. I want you to get to that point. I want you to have the courage, as I said, to really bluff your way into these conversations instead of just stop talking about it.
Okay, great. Thank you, Craig.
Yep. Okay, as I said, we need to add a couple of more ingredients, and we are about 7 minutes away from the top of the hour. Let's see if we can march through capital gains tax. This is on page 7. As I've said several times now, for our purposes, the capital gains tax, it's the tax on the profit of the sale of an investment. It's actually most any property that you own. If you sell it for less than or for more than you paid for it, that profit, that difference, that appreciation is going to be taxable. Long-term capital gain means that you held it for more than a year before you sold it. And long-term capital gains are taxed at very, very preferential rates, 15% for most taxpayers, 20% for the very wealthiest taxpayers, for those in the very highest income brackets. That has long been a feature of our tax law. We prefer capital gain income to wage income. If all of your income is wages, you'll pay up to 37%. If your income is long-term capital gain, you'll pay a maximum of 20%. Just to make that, to put a fine point on that, those Wall Street folks who get those multi-million-dollar bonuses each year, those are paid out as long-term capital gain. So they are not paying 37% on that money, they're paying 20%. And we could have a philosophical debate on why the tax system is that way. The argument in favor of it is this encourages investment. One of the other features of the capital gains rules is if you have short-term capital gain, that means that you bought the thing and sold it for a profit, having held it for 1 year or less, all of that gain is taxed as ordinary income. The reason is, as a matter of public policy, we do not want to encourage short-term investors. We want people to buy and hold for the long term. So there's a great advantage to not selling in a year or less, because you could pay taxes up to 37%. If you hold it for more than a year, maximum tax is going to be 20%. Here's the magical point for us. If you give long-term capital gain property to charity, that capital gains tax simply goes away. You don't pay it at all. The charity now has the long-term capital gain property. Let's say it's stock. Charity sells it. Charity's tax exempt. It doesn't pay that capital gains tax. So all of that money goes to work for the charitable mission. So as we'll see in a minute, even for those who do not itemize, there's a huge advantage to giving long-term capital gain property. It's a little extra work for us. We're probably going to have to work with a stockbroker. We're going to have to make sure that we receipt it properly. But for our donors, and especially for our donors who no longer itemize, we should be encouraging them to give us long-term capital gain property. So then the next question is, if I give you cash, if I write a check for $10,000, it's clear what my gift is worth, right? $10,000. That's the number I wrote on my check or approved on my credit card. But what about non-cash gifts? And we'll get into more detail about the tax filings on this a little later today. But for publicly traded securities, which is going to be, as I said, most of the non-cash gifts that you get, for publicly traded securities, the deduction is for the average between the high and the low prices on the date of the gift. So if I give your organization 100 shares of Facebook today, tomorrow we go to the Wall Street Journal, we take the high and the low today for Facebook, and I get to deduct the average share price. That's just the rule. So anything in general, anything that is published in the Wall Street Journal is a publicly traded security. The deduction is for the average between the high and the low on the date of the gift. We as an organization are probably going to sell that stock. We're going to receive some number different than that because we're not going to hit it spot on. As the donor, I do not get to take the price at the moment that it transferred to you. I do not get to take the highest price, nor do I have to take the lowest price. I get the average between the high and the low. For anything else that is not cash, the deduction is for the fair market value. And this long sentence is really worth remembering because, first of all, it's what the law says. And secondly, you can dazzle people. Well, we don't so much go to parties anymore, but you can dazzle people as you're speaking to them through their masks. The fair market value is the price arrived at between a willing buyer and a willing seller, both with equivalent knowledge of the facts and circumstances surrounding the transaction and neither being compelled to complete the transaction. It's the price that two reasonable people would agree to. Fair market value almost always is an estimate. There are some rules, and again, we'll dig into these more later today, but if you are taking a deduction for more than $5,000 for a non-cash gift, you're going to need a qualified appraisal to determine that value. One of the supplemental materials that I gave to you is the IRS Form 8283 and its instructions. I do that not in any sort of joking way. The instructions to Form 8283 have been a very useful tool for me to help donors understand these rules around qualified appraisals. And I will bore you with the Form 8283 later today, but keep in mind, if you're going to give stock, publicly traded securities, average between the high and the low on the date of the gift. Anything else that's not cash, it's fair market value. If I'm taking a deduction for $5,000 or less, I can estimate that fair market value. I can't make it up. I've got to have some basis for that estimate. But if I'm going to take a deduction for more than $5,000, then I've got to go get an appraiser and we've got to do some more paperwork. We'll go over the paperwork in detail. So by my magic clock, we are now at the top of the hour. So unless someone wants to ask a 30-second question, I'm going to call time and look at whatever clock you're looking at and come back in 10 minutes.
Can I ask a 30-second question?
Sure.
I think I'm missing something. If a donor gives a $10,000 stock gift and it's long term, so they don't pay tax, or they give it to us, there's no tax burden on them for that long-term capital gain. Do they also then get a charitable deduction on top of not paying taxes for that capital gain?
Remarkably, the answer is yes, absolutely.
Okay, great. Thank
So
you.
as you'll see in the example, they'll get a $10,000 deduction and they'll avoid the capital gains.
Great, thank you.
It's magical. All right, see everyone in 10 minutes. Then, but that Tax Reform Act of 17 made a big difference. Very few people itemize anymore. And I can read it on some of your faces now. You're thinking, so why do we need to know all this stuff? Because after all, 9 out of 10 donors aren't going to be able to get any advantage out of the charitable deduction. Here's the thing about that number. Remember, that percentage is of all the 180 odd million tax returns, income tax returns that get filed each year. That's the percentage. For our donors, that number is quite different. Higher income individuals are more likely to itemize than those who aren't. But still, we need to be aware that this idea that everybody's going to save taxes, everybody's going to be able to take advantage of the charitable deduction, just isn't so. And it was undermined quite a bit by the doubling of that standard deduction amount. So don't give up the ship. I still think this is worth knowing and worth being able to talk to people about. Any questions that you thought of while we were on our little break there? All right, let's start to pull this together with an example, and I trust someone will let me know if you're not seeing my full screen anymore. Let's use an example. This example is on page 9 of your text. And to illustrate this, it's a very simplified example, but I said, let's assume that we have a donor. She's been a loyal donor to our organization. And this morning she was seized by a fit of philanthropic intent and decided, today's the day I'm going to make a $10,000 gift to the organization. This is great news, right? She's been a loyal donor, but this is the biggest gift she's ever made to us. And as she is sitting at her desk with her hand poised to write out a personal check for $10,000, she stops. This is never good news when we're fundraisers. She decided to make the gift and now she's pausing, and it's even worse because she's pausing because she remembers something that you told her. You said something about appreciated securities. And as it happens, in her Schwab account, she also has securities that happen to be worth exactly $10,000. And now she's wondering, should she give the cash or should she give the appreciated securities? Those securities cost her $2,000 some number of years ago, so they are long-term capital gain property. And we need to help her figure out, because we want her to make this gift, we need to help her figure out what would be the advantage of giving the securities as opposed to the cash. We could illustrate for her what would happen. Whether she makes the gift in cash or securities, she's going to make a $10,000 contribution. So it's kind of the same to our organization. We're going to be able to do $10,000 in good works because of her contribution. Whether she makes the gift in cash or securities, she will be able to reduce her taxable income by $10,000. That's real tax savings. Next year, her taxable income will be $10,000 less in the 24% bracket. She'll save $2,400 in income taxes. She doesn't get that money till she files her taxes, but her tax bill will be reduced if she claims that deduction. But if she gives us the securities, she will also avoid $1,200 in capital gains taxes that she would have paid had she sold those securities. If she sold the securities for $10,000 and she paid $2,000 for them, she has an $8,000 gain. 15% tax on that is $1,200. So in the end, The after-tax cost of making her gift is $6,400 if she gives us the securities. It's $7,600 if she gives us cash. Now, all of this is assuming that she can itemize her deductions and take that contribution deduction. Even if she doesn't itemize, though, she saves $1,200 in capital gains taxes by giving us the securities instead. So my question to all of us is, why do we so eagerly accept that check? She comes in and slides that check across the desk. What we really should do is turn that check around and slide it back to her and say, don't you have something that's worth more than you paid for it? I can show you some additional tax savings if you do. In fact, we could say to her, I was listening to this guy on a Zoom webinar who said, cash is the worst thing you can give. And you can quote me on that. Cash is, from a tax perspective, the worst gift you can make. There is always a greater tax advantage to giving something that is, to giving appreciated property. And most of us have things that are worth more than we paid for them. So all of our donors, really, we ought to encourage them to stop and think, do you have stocks? Do you have mutual funds? Do you have any sorts of investments? Perhaps you should think about giving us that instead. Takes a little bit of extra work. We'll talk a little later today about the steps involved in transferring securities. But look at the additional tax savings. She might say, yes.
Sorry, did you see Anna's question?
So she would have to pay both income taxes and capital gains taxes on those securities. So let me clarify. On the screen, if she were to sell the securities, she wouldn't pay income taxes. If she were to just sell the securities, she would pay $1,200 in capital gains tax. So $8,000 gain times 15%, that's a $1,200 tax bill. That would be added to her 2021 taxes. And she would net, in that case, put the gift aside, she would net $8,800. So the long-term capital gains tax she would pay would reduce her net from the sale. If she instead gives it to us, the capital gains tax simply vanishes, and she would receive an income tax deduction for $10,000. Did that explain that, Anna? Okay, what about this? She's sitting there looking at her account and thinking about that investment. She made it all those years ago. It's been a pretty darn good investment. Why would she give it away? She believes it's going to continue to increase in value. Well, in that instance, I would suggest to her, you know what? Why don't you give us those securities anyway? You can avoid all that capital gains to date and go ahead and buy the same stock. Separate transaction, buy the same stock today if you want. At the end of the day, you would still own $10,000 worth of that stock, but your cost basis would be today's price. You would have avoided that $1,200 in capital gains tax forever. And then in a few years, when it's appreciated in value again, we'll talk to you again about another gift of appreciated securities. Questions about that? And we see this, I see this every year. Our board chair comes in to pay his pledge at year end, and he writes us a check. And we know full well that he has investments because we know his stockbroker. But we just accept the check. We don't say to him, don't you have something that's worth more than you paid for it? There's some additional tax advantage I could show you. Part of the conversation could be, you know, if you are going to give us cash, you could actually give us, I can't do the math in my head, $13,000 or so after tax savings. That's a $10,000 gift. And if you happen to have appreciated securities like this, you could give us $15,000 or $16,000 because after tax savings, that would be a $10,000 gift. So the tax savings not only are a reward to donors, they make it easier for people to give, and they allow them to make bigger gifts than they thought possible. So let me go back and address this, and I may have confused it by saying income taxes saved. The question is still, does she pay ordinary income tax and capital gains? Close your eyes to the slide for the minute. If a number of years ago I purchased securities and I paid $2,000 for them, and today I sold those securities for $10,000, I would have an $8,000 profit on that sale. That profit is called a long-term capital gain because I held it for more than a year. That $8,000 profit is taxable, but it's not taxable as income. The $10,000 that I got is not taxable as income either, but the $8,000 profit is taxable as capital gain. So capital gains does get reported on my Form 1040. It does get reported on my income tax return, but it gets reported in a special section for long-term capital gain. And the tax rate that applies to long-term capital gain is 15% for most people, not the ordinary income tax rates. Does that clarify that? If instead, and now we're back to the slide, I contribute it to charity, the capital gains is not an issue. It simply disappears. It doesn't get reported anywhere. Nobody pays taxes on it. And I get an income tax deduction for the value that I gave to the charity, for the $10,000. Okay. All right, this is one of the weaknesses because I could see your faces better if we were sitting in a room together. So please stop and let's talk about this if that isn't clear for everyone. Okay, I'm going to march on then, but stop at any point. So let's get into some of the nuts and bolts that we have to consider. One is there are deduction limitations. And this is going to sound, this isn't the last time I'll sound contradictory, but this is going to sound contradictory. Your charitable contributions, if you itemize your deductions, are 100% deductible. But there is a ceiling on how much you can deduct in any one year. And that ceiling is 60% of your adjusted gross income. Remember, I told you our old friend AGI would come back. It is 60% of your adjusted gross income in any one year for cash contributions and 30% if you're deducting contributions for appreciated property. So in any one year, your charitable deductions cannot be more than 60% of adjusted gross income. And if you're giving appreciated property, it's 30%. The idea behind that is you're getting some additional tax savings because you're avoiding the capital gains tax. So there's a bit lower ceiling on that. The good news is there's a 5-year carry forward for unused deductions. So if someone is very, very generous and they're giving away a lot of cash this year, they can deduct up to 60% of their adjusted gross income. If they exceed that amount, the deductions that they don't use this year, they can carry forward for up to 5 additional years. So the year of the gift plus 5 additional years. There are some rules around that. You have to use the deductions as fast as you can. So I cannot make a big contribution this year and then spread the deductions out to suit me. But you have to use them up as fast as you can. But for most people with some careful planning, you can use up that deduction over the course of year of the gift plus 5 additional years. You will hear donors sometimes say to you, well, I can't make any more charitable contributions because I've hit my deduction limit. I would love to have that conversation with the donor. First of all, there's nothing to say you cannot make more contributions, and can I show you that there's a 5-year carry forward? I had a donor years ago who had he had a bit of a windfall inheritance and wanted to make some really substantial contributions to fund a memorial fund for his mother from whom he had inherited all this money. And his accountant told him, you know what? You need to give half that money this year and half next year because you're going to run into this 60% limit and that's going to stop it. And I was able to explain to the accountant, who probably should have known, and more importantly to the donor, this 5-year carry forward allows you to fund this gift now. We can create the memorial to your mother now. Use as much of the deduction as you can this year and carry forward the rest to future years. So that 5-year carry forward can save this conversation often. Gifts to private foundations are subject to lower limits. We won't get into a lot of detail about this today, but just be aware that if the gift is not to a public charity, but rather to a private foundation, the limits are lower. The other one that confuses people, and we should take a minute and talk about this, for 2021 only so far, the 60% limit is increased to 100% for gifts of cash to public charities. We saw this first last year in the CARES Act, and it was carried on to 2021. I see no reason to believe they're going to carry it forward even further. This may sound like a great deal. My goodness, that means that I could actually pay no taxes this year by making enormous cash contributions. I could eliminate my tax bill entirely. The reason it may not make sense is if you think back to that graduated and progressive rate table that we saw, you will use up, let's say you're in the 24% bracket, you'll use up your 24% deductions and then your 22% deductions and so on down. So it might actually make sense to not claim all of that, but to spread it out and carry it forward over future years. So, you know, it immediately sounds good. I can reduce my taxes to nothing, but in this case, we really want to encourage people to think carefully about the economics of it, work with your financial advisor. Maybe it makes sense, maybe it doesn't. Some of the preliminary indication is last year, the first year we saw this, it didn't work out all that well, didn't seem to motivate people. And it does have a cost to the Treasury. So I expect this is the last year we're going to see that narrow exclusion. But if you mention to somebody, you know, there's a 60% limit and they say, aha, gotcha, it's 100%. The answer is yes, it is. There's this narrow exception this year.
Hey, Craig.
Yes.
There's a question from Leah in there in the chat box. Do you see it?
I do. Thanks, Leah. I was hoping nobody would ask this question. I'm only kidding. There is, I'm going to refer you to the text. So Leah's asking, so what happens with the carry forward and what if they give both kinds? The rules get murky here. So let's say that the only thing you ever give is cash and that you exceed the 60% limit this year. Whatever exceeds the 60% limit this year, those dollars you can carry forward to next year. But next year there's a 50% limit for carry forward deductions for gifts of cash. That's not a typo, but I think it's a mistake. The AGI limit for gifts of cash used to be 50%. With the Tax Cut and Jobs Act of 17, they increased it to 60%. It is my opinion that they simply forgot to update the carry forward rules, but they didn't. So the carry forward rules say if you're carrying forward unused cash contribution deductions to a second or third or fourth year, the limit is 50%. So that's one point of confusion. The other point of confusion, but I think this one's easier to understand and it's longer standing. If you make both kinds of gifts, you give some cash and you give some appreciated property. The way it works is you have to take those cash contribution deductions first. And to the extent that they do not exceed 60%, then you can look to your appreciated property contributions. And to the extent that adding those in won't exceed 30%, then you can use appreciated property deductions. And if neither of those work out, then you carry it forward to the next year where you can do the same thing again. There's also another weird little rule which says that if you agree to take a deduction for only your cost basis for gifts of appreciated property, then it becomes a not 60%, but 50% deduction. But it affects all of your appreciated property contributions for that year. So I think the explanation in the text is pretty clear. This is one where if you find yourself getting into this area, I would suggest we know a couple of things about our donor. One is they're paying attention. They've got some sophistication, and they probably have someone who understands taxes who is working with them. So what I would say to them is, you know, I have the barest understanding of how this works. And really we should work with your tax advisor to make sure that this works the way that you expect it to. What I do know is you've got up to 5 years to use up all of those deductions, and you've been so generous that it's a little complicated for you. So let's talk to your tax advisor and make sure that you understand how this works. That's the kind of conversation I would suggest.
Okay, Craig, you have 2 more questions in the chat box.
Thank you. Can you choose which year you want to the deduction comes out? No, you can't. This is not like some other deductions, particularly in the real estate world. You have to use as much as you can, as fast as you can, with the exception of that 100% limit. You don't have to run that up as far as you can. So the idea is you've got to use it. You've got to use it as it's available, or you're gonna lose it. And I think that answers that one. Was there one prior to that, Tina?
Yes, Megan Cook asks, stated, I didn't understand why it wouldn't make sense to deduct 100% in 2021. Bless you.
Okay, sorry. Let me see how to explain this. So if I have taxable income and some of it's getting taxed at the very highest rate, I'm going to do something that I hate it when speakers do this. I'm going to go back to that table. So just close your eyes here a minute. Okay, here are the tax rates for 2021. And let's say that I'm in that top bracket. And let's say that I gave away $628,301 in cash. And I want to deduct 100%. $1 of it would save me taxes at 37%. The next, I can't do the math in my head, $200,000 would save me taxes at 35%. Then the next bit would save me taxes at 32%, then 24%. The last $19,900 of my big cash deduction would save me taxes at 10%. It might be better if I can afford to make a gift of $628,000 in cash. It might be better for me to just take the 60% and use the carry forward to bring it forward to next year, when that carry forward will save taxes at those high tax rates. Does that explain that?
Thanks, Craig. This is Megan. Yeah, that completely makes sense to me now. So thanks.
Yeah, and it's intuitively, it sounds great. Great, I can deduct 100% of my income. I can pay no taxes this year. That might not make good economic sense, though. And again, this is one where you and I are not going to lead our donors to a decision about this, but we want to be able to point out to them that they should really think about this and work with their advisors. Okay, let me see if I can bring us back to present day. Other questions?
Yes, there's one more, Craig, in the chat box.
Well, I'm going to have to enlarge the chat box.
It's from Alec Lindman, and it says, so for cash, it's initially 60, and then the carryover limit is 50.
Good. Thank you, Alex. Yes, that's right. And I can't explain why, except that I think they made a mistake. So the first year, it's 60% for cash. And if you carry cash forward to the second year, it's 50%. And it's 30% no matter what for gifts of appreciated property. And as I said, the cash limit used to be 50%. So I truly believe this was a drafting error. But it's always good policy to blame legislative tax staffers for these sorts of things. I can't believe anybody would have done that seriously. All right. So on page 11, I'm literally turning a page here now. This area starts to get murky. And now we're getting into areas where we want to be very careful that we do not lead our donors astray. Keep in mind for the next few minutes as we go through this, keep in mind that the amount of the deduction if there is one at all, ultimately that's a matter between the donor taxpayer and the Internal Revenue Service. They may make a mistake. Mistakes are tolerated by the Internal Revenue Service. There is no penalty for that. They may be trying to avoid taxes. There's nothing wrong with avoiding taxes. They may mean to evade taxes. As far as the IRS is concerned, that's a matter between the IRS and the taxpayer. They're going to rely on our advice. But if they get into trouble with the Internal Revenue Service and they go into tax court and think that they can hold up a letter from us, the tax court's going to toss that out. It's really a matter between the Internal Revenue Service and the donor. So several of these next rules that we talk about are really about us not leading our donors astray. We want to be helpful, we want to give them good information, but we've got to be careful about how much detail we provide them, because we don't know. I mean, how do I know what else is going on in their tax life? Here is one of those areas. And this one starts out simple. The concept is very straightforward. If I give a sum of money to your organization and I get something in return for having given that money to your organization, my deduction should be reduced by the value of whatever I got in return. In essence, what I did is I bought a little something from your organization and gave you some money too. I can't take a deduction for the whole amount. But the law gets pretty sticky about this. The deduction is reduced by the value of goods or services made available as a result of my contribution. So this applies to premiums and other benefits that we offer to donors to induce them into making a gift. And in fact, that's exactly the thinking of the tax authorities about this. If it was meant to induce me to make a gift, then it should reduce the amount of the deduction. Keep in mind that this reduction is for the value of the goods and services to me, the donor. It is not based on the cost of the goods and services to the organization. So if as a result of my joining your annual giving society, I get a tote bag with your organization's name on it, and the vendor gave those tote bags to your organizations, no cost to your organization, I need to reduce my deduction by the value of that tote bag. What would a reasonable person pay for that tote bag? That reduces my deduction. And this is annoying because it's such small potatoes, but the Internal Revenue Service really has focused on these for decades now. If you're going to say your contribution is tax deductible in the solicitation, and you're going to give them a premium in return, you really have to disclose the value of the premium. And keep in mind, it's the offer of goods and services, whether or not they accept them. So this plays out, and we have a couple of folks here who mentioned being involved with radio stations, public broadcasting. Public broadcasting has really turned a corner on this in the last couple of decades. Public broadcasting, frankly, used to be one of the great abusers. Join our listener society, and in return, we'll give you a tote bag, and your contribution is completely deductible to the extent allowed by law. You are specifically not allowed to say to the extent allowed by law. If you're going to say it's deductible, you have to say, and you need to reduce the value of your deduction by $12.50, the fair value of the tote bag that we're going to send you. Benefit events, another one. So we're going to invite you to our gala event. Tickets are $125 per seat. Your contribution is deductible to the extent allowed by law. You're not allowed to say that. Your contribution is deductible to the extent that $125 exceeds the value of a comparable evening's entertainment and dinner. And yes, you really are supposed to figure out what would a reasonable person pay for dinner and drinks and entertainment, and then reduce the value of the deduction by that amount. And again, if we're going to say something in the solicitation about deductibility, we really need to outline this for donors. There are some de minimis rules, and both in the text and in one of the IRS publications that I gave you in the supplemental materials, it talks in detail about those. So if the only thing you are giving them is logo items from your organization, it's part of a regular donor recognition program, you don't have to sweat that sort of stuff. If it is only a small percentage of the gift, there's a limit and you don't have to worry about that. But where they're really concerned is where you're actually offering valuable goods and services in exchange for the contribution. This is why many of you may have noticed, and you may have thought it was just your auditors being stinkers about it. Your acknowledgements probably contain a phrase that says something like no goods or services were made available as a result of this contribution. That's why that phrase is in there. It's to avoid these quid pro quo reductions. So let me stop here and see. I see a couple of questions here, and if you want to verbalize questions as well, Question about public radio stations used during their fund drives. Yes, that's exactly what this is aimed at. So, in return for your contribution, we'll send you a gift certificate good for $100 at Joe's Garage, and you can go get your oil changed. Yeah, then you need to reduce the value of your deduction by $100 because that's a clear, ascertainable quid pro quo.
I'm actually interested, though. You mentioned logoed items. I'm just curious as to kind of where that limit kind of lies, because the tote bag is of course logoed. So I'm just wondering what the limit there is.
Yeah, it is. And I'm going to refer you to the IRS publication that I gave you in the supplementals, because that number changes. It's fairly low.
Okay.
I want to say it's less than $20, and it gets adjusted periodically for inflation, like so many of these things. But check that out, and also the IRS website is a good resource to get today's or this year's de minimis numbers.
Thank you.
In regard to events, food and alcohol would be deducted as goods and services. Tent rentals, toilet rentals, I suppose, music, all of that. So keep in mind, yes, but it's not the cost to your organization that reduces the deduction. It's what would a reasonable person pay to be able to use a rented toilet. I'm joking. What would a reasonable person pay to attend an event like that? What's the value to an individual of that event? That's the amount that reduces the deduction. There's also a question here about donor advised funds. And yes, absolutely, you cannot use donor advised funds for these quid pro quo sorts of payments. You may be able to slip it by because it's probably the community foundation making the distribution. And I suppose there are people who nod and wink at that and hope that nobody notices. And it could be that they even get away with it. But that's actually approaching a real problem for the donor and for the community foundation should that ever come to light. So we don't want to encourage people to do that.
Craig, I have a quick question about donor acknowledgement on that. Is there any kind of quid pro quo when they're put up on a tile wall per se for acknowledging them, especially if it's like a business?
Yeah, good question. So donor walls probably aren't a problem. It's just recognition. Once we get into sponsorships and advertising, then it gets way more complicated. So if I am a business owner and I make a big contribution to your organization, you want to put my name up on the wall, that's not a problem. But what if I want you to put up Craig Ruck's Construction Company? Okay, maybe not a problem. What if I want you to put up Craig Ruck's Construction Company, the best in the land? Well, now that starts to be a qualitative judgment. That starts to look like a sponsorship or advertising. And if I want you to put up on your donor wall, Craig Ruck's Construction Company, best in the land and the lowest prices ever, now I'm advertising prices, and it's clearly lapsed into advertising, and it's no longer a charitable contribution deduction. The whole question of advertising and sponsorships gets complicated quickly. Some of you may be wondering, what about public radio? I listen to a lot of public radio, and I hear a lot of things that sound like commercials to me. If you'll notice, they're careful to avoid some of those things I just cited. They're careful to avoid qualitative judgments, they're careful to avoid prices, and they're careful to avoid calls to action. And so far, at least, the Revenue Service has agreed that if you avoid those things, then it's merely recognition of a sponsor donor. So there are some bright lines. And again, the IRS publications that I included for you do give you some more detail on that. Does that answer it, Jeanette? Okay. Other questions?
For donor appreciation, specifically, or stewardship, we can host a dinner for top donors, etc. Or I guess the dinner is the most common thing we do. they don't necessarily know it's not advertised. If you give at this level, you'll be invited to a dinner. So I'm assuming that does not fall under this, or I have assumed, I guess is the better way to say that does not fall under this, but does it?
Yeah, I think that's a safe assumption. So the idea is you did not hold out that dinner as an enticement to make this gift. And especially if other people were invited to the dinner, not just donors, then I don't think you've got anything to worry about at all.
Okay.
So we all tend to do, or we did back in the day, big donor events each year. They're recognition events. Lots of people get invited, including our donors. We hoist the donor to our shoulders and carry them around the room as a part of the event, but we probably don't have to worry about that. And again, the idea here is the notion that the Revenue Service has is, it's shorthand, but they really don't believe anybody would make a charitable gift unless they were induced to do so. And they think that that tote bag is enough to induce you to make that gift, and therefore, that's why we have to reduce the deduction. Other questions? Okay, and we can come back to this. Let's move on. I think this splits across pages 11 and 12. Date of gift. Let's spend a few minutes talking about the date of the gift. Again, this is one of those areas that seems really straightforward, that you can take a deduction. The date of the gift is the date on which I gave it to the organization and I could not unilaterally get it back. That it's really as simple as that, the date on which it was irrevocably given to the organization. The date of gift is not really an issue until that last week between Christmas and New Year's. And for some reason, donors like to hold on until that week, and then they rush to make these gifts. Well, December 31st is an important date, because if I make a gift before midnight on December 31st, I can take a deduction in 2021. If that gift is 1 minute after New Year's, that's a 2022 deduction. So if I mail that contribution, it's easy. It's the postmark date, or it seems easy. If I deliver it to you in person, you're an agent for the organization. It's the date that I gave it to you. Credit cards are interesting. It's the date that I, the donor, authorize the charge. Many organizations batch these charges sometimes. They only submit them every couple of days or so. That doesn't matter. The idea is I authorize that charge, and that's the date of the gift. And you can read some of the others. Electronic transfer, it's the date that the bank actually puts it in the charity's account. Physical securities, the date that I delivered them. And for a brokerage account, similar to a bank account, the date the stock hit the charity's account. Where this becomes difficult is in those early days in January. So let's say that we're closed on January 1st and maybe the 2nd as well. And on the 3rd, we get in and the mail starts arriving. And there is an envelope. It's postmarked January 2nd, and we got it on the 3rd. And inside is a check dated December 31st. And let's just say it's from your board chair. Well, so a couple of things should happen. One is I'd suggest you call her. This is a conversation that you should have. And secondly, I would suggest blame the Internal Revenue Service. Say to her, look, I don't doubt you at all. I'm sure that you dropped it in that mailbox. Maybe it was after the last pickup on the 31st. And unfortunately, it got postmarked January 2nd. So I just want you to know, we're going to send you a receipt and acknowledgement that calls this a 2022 gift. You should work with your tax advisors about whether or not you can take that in 2021. I'm not doubting at all that you intended that to be a 2021 gift, but the darned IRS says this is the way we've got to do this. Don't take this one on. These are just IRS rules, but they are serious rules, and we want to be careful that we are not sending receipts to donors that aren't accurate on the date of gift. Questions about that? I'm still tickled about the toilet rentals question here, but I think we answered that. So let's move on to substantiation requirements. So this is what our donors need from us. If you're going to claim a charitable deduction, you have to have written documentation to substantiate that deduction. So let me say that again, because it gets confusing. You can't just use a canceled check. You can't just use the memo place on your check as substantiation of your deduction. You really need to keep a record. That record can be the bank statement, the credit card statement, but you have to have that. If the IRS comes asking for it, you don't have to produce it, you don't have to mail it in, but if they audit you, you need written substantiation for all of your charitable deductions, especially cash deductions. They're going to ask if they audit you. If you're going to take a deduction for $250 or more, then you also need a written acknowledgement from the charity. That written acknowledgement can be an email form, and for many of us, that's becoming very common. I make a gift with my credit card on your website, I get an email confirmation. That's good enough. As the taxpayer, I need to keep that so that I can produce it if the Revenue Service comes asking for it. So those are the general requirements for substantiation. Now then, if I'm going to take a deduction for a non-cash gift, then it gets a bit more complicated. And we'll pull apart the 8283 in a little bit in the next section. If I'm taking a contribution deduction for a non-cash gift of $500 or less, I simply estimate the amount. I can't just make up that number, and I would be well advised to have some documentation that I keep just in case I need it. So I'm going to take a deduction for $500 or less. I'm going to go look for recent sales on eBay for similar items. I'm going to print those out and keep them because that gives me a reason for having this, for taking this estimated value. If I take a deduction for more than $500 through $5,000, I still get to estimate the value, but then I have to fill out this form 8283 and attach it to my tax return. And when we look at the 8283, you'll see where that all gets filled out. I have to attach that to my tax return explaining how I valued it. I looked on eBay, I found 3 of them. Here was the range of prices. I need that kind of explanation. I put in a footnote there, and we can thank Senator Charles Grassley from Iowa for this rule. About 15 years ago, Senator Grassley became convinced that people were chiseling billions of dollars out of the Treasury each year by inflating the value of gifts of used clothing to the Goodwill. And so we are now burdened with a requirement that for contributions of for deductions of more than $500 for contributions of used clothing, it requires an appraisal. I know it's silly. I don't think anybody actually gets an appraisal, unless it's some work of art, but just be aware that that requirement is there. If I'm going to claim a deduction for a non-cash gift of more than $5,000, then I have to get a qualified appraisal. And in the supplemental materials, you have the instructions for 8283. They include a long discussion of what constitutes a qualified appraisal. And there are some more steps. The 8283 has to be signed by the appraiser and by the charity. A little later, we'll look at that 8283. You will see that the charity is not verifying the value at all. The charity is simply saying, yes, we got it. So it's the appraiser who is setting the value and signing the 8283 when it's greater than $5,000. So these are the steps that a donor needs to substantiate a contribution for a non-cash gift. Questions about that?
So Craig, I have an example right now that's going on, electrical equipment. So it's interesting because it's not just one piece of equipment that needs to be worth 5,000. It's like all of it together because it's like in a similar class, right?
Yep.
It's all of it together needs to be over 5,000 to get the appraisal.
Yeah, and there's an interesting, this will save us some time later on. So you'll see in the 8283 and its instructions, they're very specific. It is items or like items. Sometimes donors will play games with that. I had a donor a number of years ago who happened to own a series of gyms and had really very expensive professional grade exercise equipment. And I don't remember exactly what, but he gave us, let's say, a treadmill, a rowing machine, and an elliptical trainer. And he said, those are 3 separate contributions, so I don't need an appraisal and I don't need an 8283 because none of them singly was worth more than $5,000. I said, well, let me send you a copy of the instructions to 8283. Here's what it says. To me, that seems like 3 like items. They're all 3 exercise equipment, but maybe there are big differences between a treadmill and elliptical trainer. You need to work with your tax advisor. In the end, I know that we did not sign an 8283, so I'm assuming he went forward and claimed that deduction. But at least I had talked to him. He had consulted with his advisors. I don't know whether the IRS ever came and asked him. I do know the Revenue Service gets jumpy about 8283s. And just to lead us off track a little bit here, we hear talk these days about greater enforcement, beefing up the IRS's enforcement initiatives to try to raise more revenue for the federal government. One very easy thing for the Internal Revenue Service to do would be to pull the 8283s and look at the valuations. And they could easily go back and start asking people about those valuations. So this is one where we want to be knowledgeable about it. It's really not our issue. We are simply going to sign that 8283 if we need to, and it simply says we received it. It's really between our donor and the Internal Revenue Service as to how much they claim. So sorry for the digression, but thanks for the comment, Leah. Other questions? All right, let's talk.
I'm sorry, I do,
Yeah.
just because, and forgive my ignorance here, but
no, not at
so
all.
am I to understand then that he was gifting you these 3 units, potentially, and that your organization would then be required to turn them for a profit and search, or is he selling them and then you're part of the transaction somehow?
Oh, no, I'm sorry. In that example, it was actually at when I was at Minnesota State University. It was equipment that we could use. Our athletic department loved it, and they put them to use right away.
Got you.
So
Okay.
they were valuable and useful. The coaches were excited, but he insisted that they were 3 distinct, separate items.
I see.
Maybe
you.
so. I don't know.
Yeah, right.
Good question. Thanks.
Mm.
All right, let's look at another bizarre little corner. So personal property. Personal property is anything that's not real estate, technically. So it's all the stuff that people own. Could be books, collections, equipment, anything like that. And for personal property, in general, you'll get a deduction for today's value of that property. It's a non-cash gift. You may need an appraisal depending on how much it's worth. But you may also encounter something called the related use rule. This is an interesting little corner of the law. What the related use rule says is if that item of property can be put to a use that is related to our tax-exempt purpose, then you can take a deduction for full fair market value. If, however, that item it cannot be put to a use related to our tax-exempt purpose, then your deduction is limited to cost basis. I'm sorry. The thinking behind this in tax law is, well, if it's not related to our tax-exempt purpose, then we're probably going to sell it anyway. So then it's kind of like just income property. So that's why we have this difference. This plays out in a couple of different ways, and I created an example a couple of years ago that I liked. So I'm going to show it to you now. Let's say that I'm a machine shop owner, and I have a Bridgeport milling machine. Some of you will know what a Bridgeport milling machine is. It's an important tool that we use in machine shops. I happen to have one. It's used, but still quite valuable. I could sell it on the open market today for $17,500. My cost basis, because I'm a business, I've taken depreciation deductions. My cost basis is $5,000. So here's the Bridgeport milling machine all ready to go. If I contribute that Bridgeport milling machine to the daycare center, where it is unrelated to anything involved in their tax-exempt purpose, my deduction is $5,000. If instead I contribute it to the VOTEC, where they know what a Bridgeport milling machine is and they can use it, my deduction is $17,500. So watch out for the related use rule. Here's the other place this rule comes back and bites us. If you solicit items specifically with the intention of selling them at a charity auction, that is an unrelated use. So it doesn't come up often, but if you're soliciting items for use in a charity auction, our donors' deduction is limited to their cost basis in that item. It's an unrelated use gift. Questions about that? And there is some description in the text. And again, those IRS publications are really valuable on this. And I am realizing I ran a minute over the top of the hour. I should have noted that some of you have these migraine-like looks about your eyes. So let's take a 10-minute break again, and whatever your clock says right now, add 10 minutes to it and we'll come back at that time. So see you in 10. There we go. Are you with me, Tina?
Yeah, sorry, I got sidetracked.
No, that's all right. I probably have a way to do this, but if you could bring up question number 4.
Yes.
This is going to just be a guess for most people, I'm guessing, because I'm probably the only one who worries about this. But the question is, what percent of tax returns include a Form 8283? And your choices are have we got it?
Are you guys not seeing it?
I'm not seeing it. Nobody's seeing it. Oh, there it is.
Sorry, I missed one
See?
button.
Audience participation. So what percent of tax returns include a Form 8283? Is it 6%, 17%, 23%, or 47%? Remember, an 8283 is required when somebody takes a deduction for a non-cash gift, a deduction greater than $500.
Can everybody see that? Because no one's participating.
I can see it, but I can't vote on it. It's not allowing me to vote. It's
How weird.
Says the poll is closed.
Oh yeah.
Say that one more time.
We
Okay,
can't vote.
It says you're showing the polling results, not the polling
Okay,
question.
I'm going to try this one more time. Sorry, I knew I'd screw up sooner or later. Okay, here we go.
See, I heard these stories about election fraud. I didn't know we'd experience it here. Okay, there we go. You should be able to vote now. 6%, 17, 23, or 47.
I'm not seeing it.
Yeah, we can't see it yet, the poll.
I got an idea. How about if I just tell you the answer?
There you go.
Yeah,
Okay,
sorry,
I'll do
Craig.
that. No, that's fine. This is part of the fun of Zoom. So the answer is about 6% of tax returns include an 8283. I mean, it's really small. And 90% of those are for deductions of $5,000 or less. So now we're talking about 1% of tax returns where it requires an appraisal and all that other stuff. So it doesn't happen. It doesn't happen that often. But of course, these tend to be larger gifts, and they tend to be the gifts that we're going to have to spend some time working with our donors on. Let me pause here and see if there are questions. There's one in the chat box. Can I define donors' cost basis again? And I think I probably made that complicated by using the D word here, depreciation. So for our purposes, most of the time we are talking about what that piece of property costs the donor. That's their cost basis. In the example I used here, it's a business. And businesses are allowed to deduct depreciation from their taxable income each year. And without going into a long dissertation about depreciation, the basic idea with depreciation is you use up a little bit of that thing, in this case, that milling machine, each year to produce taxable income for your business. And so you get to deduct the little piece of that machine that you used up each year. From a tax perspective, what that does is it reduces your cost basis. So you've already gotten some tax advantage by using up some of that depreciation. And then when you go to sell it, if you make a profit on it, you're going to have to pay a tax on that. So I want to kind of stop there because depreciation really gets very complicated very quickly. It's been used over the years. Depreciation has to encourage people, to encourage certain expenditures. So if you want to encourage a business to make an investment in a new plant, you allow them to depreciate it over a shorter period of time rather than the whole useful life. For our purposes, most often what we're going to see is cost basis is whatever it costs the donor in the beginning. So sorry that I added complexity there. Does anybody else have any questions that occurred to you while we were taking that break? Okay, let me move on to one other area that's going to seem counterintuitive, and then doggone it, when you think about it, it makes perfect sense. So ordinary income property. Ordinary income property is something that if you sold it, would cause you to have to pay income tax. So we think of, for example, inventory. If I am a bookstore, I buy books, and when I sell those books at a profit, that creates ordinary income for me as the owner of the bookstore. If I give ordinary income property to charity, my deduction is limited to the amount that would not be taxed as ordinary income if I sold it. So generally, the cost basis. So again, if I'm regularly in the business of a bookstore and I hold inventory, and I give that inventory to you, what the IRS says is, aha, he is avoiding creating taxable income for himself, so we are not going to let him take a deduction for the full value of those books, because he never paid income tax on that income, on that profit. His deduction is going to be limited to his cost basis. It plays out for us in several important ways. One is, if you give a gift of short-term capital gain property, so stock that I bought and sold and bought less than a year or less ago, if I sold that, it would create ordinary income. If I sold it after a year, it's long-term capital gain income, and we talked about how that works. If I give that short-term capital gain property to charity, my deduction is limited to cost basis. The reason is I'm not paying the income tax on that short-term capital gain. For gifts of services, there's no deduction at all. In the eyes of the Internal Revenue Service, what I'm doing is I could have taken that time and used it to generate taxable income. Instead, I'm using that time to benefit your organization. I avoided generating taxable income for myself. I'm not going to get a deduction for the value of those services, no matter how valuable they are to your organization. We still want to encourage donors to make those sorts of gifts, but there's not going to be a tax deduction for that. Where it can be difficult to explain to a donor is this last example that you see on your screen. Consider an artist who contributes her own work of art. Her deduction is limited to the cost of materials. So in the eyes of the Internal Revenue Service, that sculpture that she gave you is nothing but a block of stone, plus the labor that she added to it to create that work of art. And if she had sold that work of art, she would pay ordinary income tax on the appreciation in value, on the difference in value between the materials and what you were willing to pay for it. But she's not, and so her deduction is limited to the cost of materials. That one can be particularly difficult. It seems punitive until you stop and think about it from the Internal Revenue Service's perspective. The only thing it is, it's just a hunk of stone until she puts some labor into it, and if she's not going to be taxed on that labor, she can't deduct it. If she gives that work of art to me and I contribute it, I can take a deduction for the appraised value of that sculpture, but she can't. And I've heard people do all sorts of stretches involving, some sort of jointly owned property that then gets given to a spouse and then back to I would suggest not. No, we don't really want to go down that road. It's really just a hard and fast rule about ordinary income property. Questions about that? All right, a couple of notes about depreciated property. There's some text on page 15 for you. We have been assuming all along that everything appreciates in value. Sometimes it doesn't. Sometimes things are actually worth less than we paid for them. Generally, we do not want to encourage donors to make gifts of depreciated property. So securities that are worth, less than I paid for them, don't encourage me to give those to your organization. The reason is my deduction will be for today's current fair market value, which is less than I paid for them. It's not your business to give tax advice to your donors, but you might suggest that selling depreciated property might make more economic sense. Check with your tax advisor, check with your financial advisor. If you sell something for less than you paid for it, you might create a capital loss deduction that you might be able to use to offset other capital gains. But for our purposes, not a good idea to make a charitable gift. Here's a little table, and you'll find it on page 15, showing exactly what we're talking about. If I'm our donor in the 24% bracket, and I've got stock that's now worth $10,000, but instead of the one we looked at earlier, this one cost me $15,000. So if I sold it, I'd have a loss. If I give the securities, I get a $10,000 deduction. I save income taxes. If I sell and give the cash, I still get a $10,000 deduction and I save income taxes. But I also have a capital loss. And again, it's not our business to do financial planning for our donors, but it could be better for me to have that capital loss and use that to offset other gains. Questions? Okay, we're going to turn the page now on page 15 and pretty much for the rest of this module. Let's talk just briefly about transfer taxes. So far, all morning, we have been talking about income taxes. Income taxes are taxes that you pay when you create income for yourself, when you receive income. Transfer taxes are totally the opposite. Transfer taxes are taxes that I pay when I give something of value to you. And theoretically, transfer taxes apply every time I give something of value to another individual. Most of us never encounter them for a couple of reasons. One is there is an annual $15,000 exclusion per individual. So if I had the means, I could give each one of you $15,000 this year. Great news, right? And I wouldn't have to file a gift tax return. Nobody would need to know about it. It just flies under the radar. If I gave $1 extra to one of you, then I would at least theoretically have to file a gift tax return for that $1. Chances are I wouldn't pay gift taxes anyway for reasons that I'll show you in a minute, but $15,000, any number of individuals, married couple filing jointly, $30,000, any number of individuals each year. You will see sometimes in farm country, an organized plan where mom and dad give parcels of land worth $15,000 to the kids each year as a way to try to avoid eventual estate taxes. The other reason most of us never see the gift and estate tax is this. There is a lifetime exclusion of $11.7 million that I can give free of taxes. I might still have to file a gift or estate tax return, but essentially the tax on the first 11.7 million is prepaid for me. That 11.7 million is the cumulative total of my lifetime taxable gifts plus whatever I leave at death. There's an unlimited exclusion for amounts that I leave to my spouse, and my spouse and I together have doubled that amount. So we have 23,400,000 that we can give tax-free. So between the two of us, until we cross that threshold, we're never going to have to pay gift or estate taxes. However, when that tax kicks in at $11,700,001, it's taxed at 40%. That's a tax that I pay for the privilege of giving it to someone else. The 11.7 million is adjusted every year for inflation. So it'll be a different amount next year. This is the amount for 2021. The 15,000 is adjusted for inflation as well, but they only change it in $1,000 increments. So the effect is it's every 4 or 5 years before that changes. It's been at 15,000 for the last 3 years or so. So in the next year or two, we'll see that go to 16,000. The table probably is the best summary. As you see on the screen, up to $15,000 per year, I don't have to do anything. I don't have to tell anybody about it. If I give more than $15,000 in any one year, I'm going to have to file a federal gift tax return, but I won't owe any taxes unless the cumulative total of my lifetime gifts on gift tax returns exceeds 11.7 million. And once that total exceeds 11.7 million, then I have to start paying at 40%. So altogether, 11.7 million, twice that amount for a married couple filing jointly, and then it's taxed at 40%. The key points are fewer than 0.1% of all Americans ever encounter the transfer tax these days. They may be having to file gift tax returns for their lifetime gifts, but that 11.7 million is going to cover it. There's another footnote that I'd encourage you to read. This is another one of those corners of the tax law that is going to change beginning in 2026 unless they do something. The 11.7 million was effectively doubled by the Tax Cut and Jobs Act of 2017. And unless they do something, it's going to be cut by half in 2026. And it's interesting to speculate what might happen late on December 31st of 2025, because what it really means is if I die before midnight, I can leave 11.7 million. If I make the mistake of living through midnight, it's half that amount. So again, it's worth watching how some of these tax laws are going to change. One final point I wanted to add about transfer taxes, it's on the bottom of slide 19. And you've heard some talk about this lately. There is a stepped up basis for transfers at death. So what that means is if at death you inherit from me capital gain property, something that's appreciated in value, and then you sell it, you will owe taxes only on the change in value from the value on the date of my death. So if I leave, for example, my house that I bought back in the 1960s that is now worth 10 times what I paid for it, if I leave that to you in my estate and you sell it, you will pay essentially no capital gains taxes. If I give that same piece of property to you during my lifetime, it has what's called a carryover basis. The carryover basis means if you then sell it, you will owe capital gains tax on all of that appreciation from when I bought it. So carryover basis for gifts during lifetime, stepped over basis for gifts through the estate. There's been a lot of talk about changing this rule, which could generate a substantial amount of money for the Treasury because it is effectively allowing very wealthy individuals to pass all of that gain on to the next generation without taxes. So as the debate rages on for the rest of this year, watch for discussions about stepped up versus carryover basis. Questions? Let's move on to pages 18 and on. And I want to include this here, but it really won't start to make sense until the second part of next Tuesday. But it's important to do it here because it actually seems to run counter to some of the quid pro quo things that we talked about earlier. So a split interest gift, and we're thinking here primarily of charitable gift annuities or perhaps charitable remainder trusts. A split interest gift happens when the donor breaks apart the right to receive the income from the property from the right to own the property. And what they've done is they have irrevocably given the right to own the property to the charity, but they've retained for themselves the right to receive the income. They've split the two interests. The two interests together, the remainder interest plus the income interest, equal the full value of the property. If what they've given the charity is the right to the remainder, then they can take a deduction for that value. And we won't, you should be relieved, we will not go into a lot of detail about how that gets calculated, at least here today. But essentially, it's the present value of the charity's right to receive the remainder. So there are IRS regulations and formula that we use to make that calculation. We use something called the IRS discount rate to figure out what's the present value of the charity's right to receive that remainder. For life income gifts where there are older beneficiaries, the deduction is going to be larger because the charity is going to receive the remainder sooner. If there are very young beneficiaries, the deduction is going to be smaller because the charity is going to have to wait longer to receive the remainder. Similarly, if there's a very high payout, the deduction is going to be smaller because the individual is going to receive more income. So keep this in mind when we get to the last part next Tuesday, but it's important to consider here, it actually is the quid pro quo rule playing out. What did you give the charity? I gave them the remainder. So I get a deduction for the remainder, but of course I don't get a deduction for the income that I'm receiving. For our donor who has just given us $100,000 in exchange for a gift annuity, why don't I get to deduct the $100,000? Well, it's because you received an income in return for it, and that reduces the value of your deduction. Again, there's more in the text that you can read about this, and we'll cover in a lot more detail next time around. Questions? Okay, seeing none, we have arrived at part 2. Congratulations. This begins on page 21 in the handout. And I want to add a little detail to several of the assets that we've talked about. We'll go through in a fairly quick fashion gifts of securities, so stocks, bonds, and mutual funds, and some of the rules for transacting these gifts. I want to dive just a little bit deeper on the Form 8283. Then we should talk a little bit about real estate and a little bit about personal property. And I want to focus here more on not just the rules, but on the conversations that we want to have with donors about these gifts. To start with, and this is not in your handout, these are data from the Treasury. The US Treasury has a wonderful file called the Statistics of Income file. It's a gigantic spreadsheet, but it has all these data in it. This one fascinates me, and it's pretty durable. This is the way that people hold their wealth. So broad average, most Americans have about 1/3 of their wealth in stocks and bonds, about 45% or so in real estate, about 12% in personal property, about 10% in retirement accounts, and about 2% in cash. Just that little yellow sliver is the percent of wealth that is in cash. Part of the reason this fascinates me is when you think about our fundraising strategies, what do we ask people to give us? We ask them to give us cash. Why are we ignoring 98 cents out of every dollar that they could potentially give us? I mean, stocks and bonds are relatively easy to transact, and yet we talk to them about cash. Real estate, it's a little more complicated. Personal property, there are some pluses and minuses there. Retirement accounts, we'll talk more about those next week. But our solicitations tend to focus on cash. So this is why I think it's worth spending the rest of our time here today talking about some of these other things that people could give us. We really ought to be open to the other 98 cents out of every dollar that they could afford to give us. So let's first talk about stock. Stock is equity ownership in a corporation. So if you think about it this way, stock is really just a little sliver of, it's a partial ownership in the corporation. The share value changes from day to day. So Facebook, again, if we want to figure out what Facebook, the corporation, is worth, we simply take today's share price and multiply it by the total number of shares outstanding. And that's the value of Facebook today. Each share represents one tiny fraction of ownership in the company. And yes, Mark owns 51% of those shares, so he's the majority owner of Facebook. Stock may pay dividends, it may distribute income, but it doesn't have to. I would say 25 or 30 years ago, it was common for stocks to pay dividends. Over the years, that has shifted. We used to talk of blue chip stocks that you could own and collect the dividends and live happily on the dividends. That shifted over the years as it became more advantageous from a tax perspective for stock to distribute capital gains. And so many corporations now no longer focus so much on the dividends they're going to pay to their shareholders, but rather they take the profit and reinvest it in the corporation. The idea is, if as the CEO, I'm distributing dividends to my shareholders, I'm creating ordinary income for them, taxed at up to 37%. If instead I keep those profits, invest them in the company, and the share price goes up, then my shareholders can get long-term capital gains income taxed at a maximum of 20%. So dividends have become less and less important. Some companies, notably Microsoft, for the first quarter century of its existence, it never did pay a dividend. They invested everything that they made back into the company. The share price went up. Everybody was happy. Shareholders could sell their stock and pay 15 or 20% instead of 37%. Dividend yields years ago were 3, 4, 5%. Today, 1 or 2% is a typical dividend yield. So stocks do not necessarily pay dividends. There are lots of different types of stock. For gift purposes, we will most often encounter common stock. But there is also preferred stock, special classes of stock, and preferred stock often has certain rights that common stockholders don't. The one for us to watch out for is so-called S corporation stock. Oftentimes people think the S in S corporation stands for small. It does not. It's actually the paragraph number of the Internal Revenue Code that describes that kind of stock. S corporation stock is distinguished by a limit on the number of shareholders that can exist. So S corporation stock is not readily traded. It's not available on the open market, but they are real shares, but there is a limit to the number of shareholders that can exist. And some very large corporations are S corporations. As a charity, we can accept gifts of S corporation stock. It's okay. It wasn't always. There used to be a broad prohibition. However, as a charity, if we accept S corporation stock and it pays a dividend, it's called an income distribution for an S corporation. If it pays a dividend, we, the charity, have to pay income taxes on that dividend. And if we, the charity, accept S corporation stock and then sell it for a profit, we have to pay taxes on the gain that we made on that sale. So it was a compromise many years ago. Prior to the law change, we weren't allowed to own S corporation stock at all, but now we are. But we do, it's this weird thing. We're tax exempt, but we still have to pay these taxes. The reason this comes up often is if you are dealing with a donor, particularly, let's say, a founder who owns an S corporation and is willing to give you a contribution of S corporation stock in his or her corporation, be sure to work with your business office. They may need to do some extra tax filings. They may have to pay a little bit of unrelated business taxable income. It's not a bad thing, but they need to be prepared to do that. Moving on, contributions of stock depend entirely on how the stock is owned. Most stock these days, I expect, is owned in a custody account. So our example previously, the Schwab account that our donor had, that's a custody account. There are no physical shares. Those shares exist in some electronic file somewhere. Sometimes you'll see it called street name, or DTC, stands for Depository Trust Corporation, or perhaps book entry. They're real shares, but they exist only as electronic entries. For a custody account, we want our donor to call her broker and tell her broker, transfer 100 shares of Facebook to your organization. The broker enters codes and pushes buttons, and it all happens electronically, and the stock gets transferred to our organization's account. Some people still own physical shares. Remember those old, they're oversized sheets of paper. They've got elaborate engraved printing on them. If our donor owns physical certificates, the easiest way to transfer them is the worst. And that is, you turn the certificate over, there's some paperwork you fill out on the back and you sign it, and then hand the certificate to you as the agent for the charity. We don't want our donor to do that. What we want them to do is fill out a stock power, which is a separate piece of paper that says the same thing that it says on the back of the stock certificate. But that way we have two separate pieces of paper. And the reason is, once a physical certificate is endorsed, it becomes what the lawyers call a bearer instrument, which means anybody who physically has that endorsed certificate can trade it, can sell it. They own it. So physical certificates, we want a stock power separate from the certificate. And then I already talked about concerns for S corporation stock. Here's the thing to worry about. We want our donors to transfer the stock, not the proceeds from the sale of stock. Sometimes, not terribly often, but sometimes somebody gets a little over exuberant and the donor calls and says the wrong thing to the broker. And the broker calls you and says, good news, your donor directed me to sell 100 shares of Facebook. Where do I send the check? Well, guess what happened? Our donor has just triggered capital gains because he directed the sale of the stock. So it's very important that we make sure that our donors understand, transfer the shares, not the proceeds from the sale. We're probably going to sell them anyway, but we need to be the ones, we the charity need to be the ones who make that order to sell. Let me stop there because I know that somebody is entertaining a gift of stock within the next day or two. Any questions about that? Okay, I don't see
Yeah,
any.
I had one little, because you had also earlier mentioned, we would pay income tax on S Corp
Yes.
stock, right? So that would then presume that we could have a portfolio of common and preferred, and that we wouldn't pay taxes on if we made sales of.
Right, that's correct. So if you're speaking now as a charitable organization, I can have a portfolio of common and preferred stocks, bonds, mutual funds, anything like that. Let's say in my endowment portfolio. I'm tax exempt. I don't pay income taxes. I don't pay capital gains taxes, with the exception of S corporation stock. As a tax exempt entity, if I own S Corp stock and I collect income from that stock or I sell it at a profit, I'm going to pay unrelated business taxable income on it.
Okay. And then, so you had mentioned though, in that one kind of hypothetical though, that more than likely you would end up selling the stock after they traded it to you. And I'm wondering, why would that be the case then necessarily?
Yeah, so let's explore that. And for those of you who are, it's first time around on a gift of stock, the question often arises, so we have just received this nice gift of stock. What are we going to do with it? It's very tempting to suggest that this stock is going nowhere but up, so let's hold on to it. Let's time the market for selling it. Enough organizations have been burned often enough on that many organizations have a standing policy that we liquidate gifts of securities upon receipt. I like that policy because it's easy for me to explain to donors. Look, we're not in the business of timing the market. We're in the business of saving the children. And so we don't even try. You give us that stock, we will sell it just as soon as we can because our mission is that important. You can have a policy that also allows an exception. So maybe whether it's your investment committee, wherever you want to delegate that authority. So you sell upon receipt unless there's an exception, because sometimes there are exceptions. What I would caution you against is any sort of scenario where the donor says, I'm going to give you this stock, excuse me, and by the way, winking all the way, if you hold on to it for about 10 days, it's really going to increase in value. I'd be leery of that because, first of all, who knows? And secondly, there's a chance that maybe you're getting some insider information there and you don't want to be on the wrong side of that kind of equation. So I think a good policy is we sell it because that's the best for our mission. We make exceptions when we need to.
Okay.
Does that speak to that question, Alec?
Yeah, definitely. Thank you.
Okay.
So you consider, this is just a question of definition, you consider stock gifts planned gifts?
No, but many organizations consider that to be gift planning.
Interesting.
So
okay.
That's why I include it here. And these are the most common non-cash gifts that we'll see.
Thanks.
And again, thinking back to that table, it's such a great thing for donors, especially non-itemizers. We ought to be talking to them about gifts of appreciated stock. Other questions? Okay, let's jump on to bonds, and we can do this relatively quickly. So a bond is not a stock. A bond is an IOU. A bond is really the investor loaning money to the bond issuer. The bond issuer agrees to pay interest and then give the money back. Bonds can be sold and traded, and bond prices vary inversely with interest rates. And I want to pause for just a minute and think about why that might be so. So I put together this table. If you are an investor and you've found a bond that pays $600 per year and then refunds $10,000 at the end of some period of time, a decade or two from now, what would you pay for that bond? Well, the answer is it depends upon what today's interest rates are. So if today I'm looking for that bond, and today most places I can get a safe return of 6%, I know, if only, but let's just use this example. I'd pay $10,000 for that bond. It's paying $600 a year, that's 6%. 6% is the best I can do with my $10,000 anywhere else. So I'd pay $10,000 for that bond and be happy about it. If a couple of years from now I want to sell that bond and interest rates have changed, then the answer to what is my bond worth depends. If the going interest rate when I sell that bond is 8%, I'd only be able to get $7,500 for it. And the reason is anybody in the market at that time can get 8% for their $10,000. $600 is 8% of $7,500. That's what somebody would pay me for a bond, for a 6% bond in an 8% world. If a few years from now, when I sell that bond, interest rates have fallen, they've dropped to 4%, my bond will have increased in value. And the reason is in the world, in that world, 4%, $600 is 4% of $15,000. My bond has increased in value. So bond prices vary inversely with interest rates. Now, part of the reason this is interesting is we have been in a period of extremely low interest rates for a long, long time now. And so bond prices have gone up. And the interesting question is, what will happen if interest rates increase? What will happen to those bond portfolios? The value of those portfolios is going to fall. And bonds typically are considered to be the secure investment. They're the fixed income part of the portfolio that we use. We can take some risk with the equity part of the portfolio, but with the bond part, that's our safety. And some people are a little worried about if interest rates increase very dramatically, we could see bond prices fall pretty dramatically. There are lots of different types of bonds. Sorry. Corporate, municipal, US government. There's a weird thing called a zero coupon bond. That's a bond that doesn't pay any interest at all. Sometimes they're called original deep discount bonds. With those, what you do is you pay a price now for the promise that you're going to get in our example, that $10,000 back some point in the future. Doesn't pay any interest at all. It just appreciates in value. So the question is, what would you pay me today for the promise of $10,000 10 years from now? You'd pay some amount for that. And the difference is that zero coupon. The advantage of zero coupon bonds is they do not produce taxable income each year. And of course, there are savings bonds. One of the things to keep in mind is savings bonds don't make good gifts during a donor's lifetime. And the reason is there is almost no way to transfer a savings bond without triggering all of the taxable income. So people bought those bonds, they increased in value over the years, they didn't collect dividends off of them. And the idea was when you sell it, you're going to collect that taxable income. So if someone tries to give us savings bonds, we want to suggest to them, you know, those don't work so well. You're going to wind up paying some income taxes for the privilege of making that gift to us. Perhaps there's another asset you'd like to consider, or maybe you'd like to consider giving us your savings bonds as part of your will, because that tax does not apply in that case. The contribution mechanics are very similar to stocks. It depends on whether they hold the bonds. Few people do that anymore, or usually they're in brokerage accounts. Mutual funds, the numbers are just staggering. There's more than 8,000 funds. I just looked as I was putting this together. With 15 trillion in value, more than half of households own mutual funds. Mutual funds are essentially just big pooled investment funds. So hundreds of thousands of us get together. We put money in this fund. It goes out and buys a portfolio of stocks. For us, for our purposes, mutual funds look a lot like any other securities gift. We're going to ask the donor to be sure to transfer the shares to us. Don't sell them and send the proceeds to us. And you'll get a deduction for the fair market value of those shares on the date of the gift. You'll avoid the capital gains tax, if any. A couple of things to be aware of. One is oftentimes mutual funds come with dividend reinvestment programs. So rather than collecting the dividends, I decline the dividends, they stay in that mutual fund, and they buy little fractional shares each quarter instead of sending me a check. Well, we've got to be careful because those little fractional shares change the date of acquisition. And so some of those little fractional shares are going to be short-term capital gain. So we'll want to work with our donor's broker to make sure that we're aware of dividend reinvestment programs. And also, it should be easy, but sometimes these get complicated. As the donor, I'm going to call my mutual fund company and say, transfer some shares of the ABC mutual fund to your charity. And then the mutual fund company is going to get in touch with your charity and say, good news, you're getting a nice charitable gift, and you have to open an account with our mutual fund company. That call's probably going to come into your business office or your treasurer. And the next thing you know, they're going to have to fill out an account opening form. Sometimes that form requires social security numbers and other things that tend to make financial people nervous. I would suggest to donors who want to give you a mutual fund for year end, think about getting to work on that right after Thanksgiving. It's probably going to be fine. It's probably going to go as smooth as can be. But if we run into any trouble, we want to make sure that we have time to work that out. We can work it out in almost every case. Sometimes it gets very complicated because you never talk to the same person twice at the mutual fund. But with a little bit of effort, we can work through a gift of mutual funds. I would say this is one of the places where it's important to have communication with our donor. Far too often, I've encountered a donor who makes a very generous gift. It's of a stock or a bond or a mutual fund. They've done all the right things, taken all the right steps, and now they're sitting there waiting for your acknowledgement. The only step they didn't take is they forgot to tell you that they were making that gift. And believe it or not, your business office does not take a look at the brokerage account every single day to see what new entries have been made. And then a few weeks down the road, have you gotten one of these emails? Say, does anybody know about this 100 shares of Facebook that came into our account? We don't know where it came from. And that's true, they don't. It doesn't say where it came from. And in the meantime, you've got a donor who's stewing because he made this really big gift and you ingrates haven't even acknowledged it. So we would hope that our donors would let us know. We should ask them to let us know when you're going to make this gift. Maybe we can help you with it. If there are any hurdles, if they need tax ID numbers, anything like that, we'd like to help you with it. And we want to make sure that we recognize you, because these gifts can be, they don't get lost. We would always find them, but these gifts can be sometimes hard to track. Let me stop there before we go into real estate and a couple of other things. Are there any questions? I have no problem tolerating long periods of quiet if you want to search.
Okay, Craig, this is Betsy Hayes. I do have a question.
Sure.
So we have a donor that passed away, put us in her will to receive, a nice sized gift. And what we are being required to do is we already have a Fidelity account, but now we're being required to apply and set up a whole separate account that is supposed to be for the receipt of bequests. Is that normal?
So let me be clear. They want you to set up an account to receive specifically the mutual funds that were bequeathed to you.
Well, I don't know if it's mutual funds or stocks,
okay.
But we are being required. We already, get stock gifts and things like that, and we sell it right away because we're in the healthcare business. Yep. But we have a donor that put us in her will, and the value of what's supposed to come our way is like $180,000. So it's massive. And so Fidelity said we needed to create a whole separate account to be able to receive that bequest from Wells Fargo. Does that make sense?
Yeah, I would say it's not at all unheard of. And unfortunately, it does make sense. The world, in many ways, was much simpler back when we had, stockbrokers who looked like the guy on the card in Monopoly, and they could then transfer from one brokerage house to another. It's gotten much more difficult in these days, and Fidelity and some of the larger houses I think if you leaned on them hard enough, they would agree to transfer to a different broker, but for the most part, they don't want to do that. They want you to open an account. I would be dubious of whether or not they can force you to use that account again. So you might be able to do it for this case and then close it once you've transacted the business. But I'm not at all surprised to hear that.
But
they want to keep
Craig,
that
it's our
transaction
people.
business.
Yeah,
Oh, it's your people?
our people. Fidelity is our people. And so they're
Right.
saying that we need to set up a separate account. And so we are of the thought that then if we get a future bequest, then it's going to have to go through that account as well. It was just something we had not heard of before. So I didn't know if it was new.
Yeah. I'm trying to think of why they might want it to go that way. And it could be that they just want to have a clear
track,
a clear isolated track when it's coming from an estate.
Yeah.
Okay. Maybe just in case there's something down the road that goes haywire, they don't want to put the rest of your, they don't want to call the rest of your assets into question.
Mm-hmm.
Yeah.
Okay.
Yeah, it could
All
be.
right, thank you.
I mean, in the end, I don't know, it costs you a little bit of paperwork and some administrative time. But I would go ahead and do it.
Okay. Yeah, we are. It just is taking a long time. I'm anxious.
Yeah. Yeah,
Okay.
absolutely.
Thank you.
Okay. Other questions?
Craig, I have a quick question about some of those accounts. So we tend to get estate gifts frequently, and they come in via this method where we have to fill out all the paperwork and open all these accounts. Do you suggest leaving them open, or should we close them upon receiving the funds? So I'm just kind of curious on like how the best tracking for all that would be.
Yeah, so it's a good question, and it's more a burden for your business office. It's really their choice. I guess I would be in favor of keeping things clean, and once you're done with them, close them. The counter to that is, well, it's a lot of work setting up these accounts, and why not just leave them open in case we ever need an account with that brokerage house again. But really, your business office, along with your auditor, probably ought to make that decision. You know, I don't know what the trade-offs are.
But what if you?
I would open them and close them right away. But
what if you hope the donor makes an additional gift the following year through that same account?
Yeah, right. That's the counter to it. So then you'd have to open that account again. So it's a judgment call, and it's really has more to do with the work that the business office will have to do.
Okay, thank you.
Yep. Other questions? Okay, I'm going to call 10 then, and we'll come back at 10 minutes after the hour for the final bit here. All right, I think we are about ready to start. Tina tells me she has figured out what button we didn't click. So Tina, let's try question number 2. What percent of US households give a charitable gift each year? Is it 35%, 50, 65, 90? We are a generous people. And it's always interesting to watch. 35%, 50%, 65%, or 90%. And it looks like, okay, let's stop it there. Tina, I'm not going to touch this. So by a narrow margin, people are guessing 50%. And the fact is, according to the Chronicle of Philanthropy just last week, it is 50%. And 50% is the lowest percentage participation in almost 20 years. If you have access to the Chronicle of Philanthropy, it's really a very interesting article. Giving has increased year over year for many years, but the number of donors continues to decrease. So we have an odd phenomenon. We have fewer donors giving more. And there's some interesting questions about how that plays out for us. I'm going to close that poll now. And I saw a couple of questions as I was scrolling through here. One is backtracking a bit. For a quid pro quo, can the sponsor donate his benefit back or not accept and deduct the entire sponsorship? The answer is generally no, because the idea is it was the inducement of that premium. That's what caused you to make the gift. And the fact that later on you said, no, I don't want it. That's probably not going to cut the mustard. Now, having said that, the most conservative advice would be to say to your donor, I want you to tear up every solicitation that we sent you about this event and just send us a check. Then there's no question. Having said that, going back to public broadcasting again, they seem to have really gotten their act together over the last many years. And I am seeing solicitations now that say, in return for your contribution, we'll send you a tote bag or an umbrella, or you can check box 3, which says, I don't want either of those things. I just want to make a contribution. And that seems to be working okay. It's part of the original solicitation. But in general, no, you cannot later on ex post facto decide, no, I don't want the benefit. That doesn't work. I think that's it. Did other questions come up while you were taking your break? All right, we have a couple of more things that I want to be sure to cover today. Let me just remind us on the screen now. Remind us of what we learned this morning. Fair market value, average, or the price arrived at between a willing buyer and a willing seller, and all that stuff. Publicly traded securities, it's the average between the high and the low on the date of the gift. And then for other non-cash gifts, if the deduction is more than $5,000, we need a qualified appraisal. And I want to spend just a couple of minutes talking about that and going through what some of this paperwork looks like, because it becomes a donor service issue. It is our business office that's going to be doing this, but it becomes a donor service issue to make sure that our donors have the documentation that they need. So valuation appraisals in Form 8283. There's some material on page 13 about this. Again, and what's on the screen, I'm just going to bring all of this up. What's on the screen is mostly review until we get to deduction of more than $5,000. So if I'm taking a deduction for more than $5,000 for a non-cash gift, that 8283 has to be signed by me, the taxpayer donor. It has to be signed by the appraiser, and it has to be signed by the charity. And I'll show you what that block looks like in a minute. But if the charity signs an 8283, the charity has an obligation to keep track of that piece of property. And if the charity sells it or disposes of it within 3 years of the date of gift, we have an obligation to report to the IRS what we did with it and how much we got for it. It's called a Form 8282 that we have to file. In your supplemental materials, you'll find an 8282 and its instructions. Just an interesting sidelight, if you look at the numbers of those two forms, 8282 and 8283, that's the order in which they were issued. So the Internal Revenue Service issued the 8282, the tattletale form, just before it issued the 8283, the one the donor has to sign. So they are serious about this. Remember earlier, when I talked about increased enforcement with the Internal Revenue Service, it would be the easiest thing in the world for them to do a data pull and match up 8282s with 8283s. If they detect wide variations, I took a deduction for $50,000 on my 8283 and it was all signed and it had a qualified appraisal and everything else. And then 6 months later, the charity sold that item for $20,000. The IRS is going to come knocking, and they're not going to knock on the charity's door. They're going to knock on my door, and they're going to say, our assumption is that there was something wrong with your appraisal. So I think this is a growing concern for a number of our donors. Now, a couple of things. One is I do make sure to talk to my donors about that 8282, and I explain to them, if we dispose of this, we are going to have to inform the Internal Revenue Service, and we will make sure to tell you that we've done that. We'll even give you a copy of the 8282 so that you can see it. Sometimes a donor will say, well, why don't you just promise me that you'll hold on to it for 3 years and a day before you sell it? That doesn't work, I have to explain to my donors, because that makes the gift a conditional gift. The gift is conditional upon our holding it for 3 years and a day. Well, a charitable contribution that is conditional is not complete. And so it doesn't work. It's a condition. You don't get to deduct it until after that time period is expired. So we really do have to be careful with our donors about that. The 8283 requires signatures on behalf of the charity. That signature is whoever in your organization is authorized to sign tax returns. Do you know who that is? I don't. Most of us don't. It could be someone on staff. It could be your treasurer who sits on your board. So it's worth, if you're getting involved in these non-cash gifts that require 8283s, to spend some time thinking about what sort of process you're going to put in place. Another suggestion I would make is, excuse me, I regularly provide the 8283s to my donors. Thank you for your gift. I've noticed that it's a non-cash gift of more than $5,000. If you're going to claim a deduction, you and your tax preparer may need an 8283. Here's a copy of that form and its instructions. I'm more than happy to be your representative here at the charity to make sure that this gets signed. If you don't do that, I guarantee what's going to happen is along about the 14th of April, you're going to get a panic call from the donor's tax preparer who needs an 8283 signed, and then you're going to have to scramble around. So better to do that in advance. It really is the donor's obligation, but this is one where we can really be helpful to our donors.
Hey Craig, sorry to interrupt, but there's
Yep.
2 questions in the chat box.
Thanks for drawing my attention to that.
Sure. Told you I was paying attention.
You are. Question, isn't it likely someone with director's insurance about signing the tax return? It probably is, although I've worked for plenty of organizations where it is delegated to the comptroller. The treasurer is a board appointed position and the comptroller is on staff. So it can be somebody on staff. And can't the donor revise his or her taxes? Yes, they could do that. And actually, they would be wise to. Let me explain the question. So the question is, we sign an 8283, it's for $50,000. It turns out that for good and sufficient reasons, we can only sell it for 20. And if we're in conversation with our donor, they could certainly go back and amend their tax return. And they could say to the Internal Revenue Service, you know what, different facts and circumstances, that appraisal turns out to have been inaccurate, and I want to amend my tax return and claim that smaller deduction. That would be a really prudent thing for the donor to do. The question is, if we get stock worth $6,000, we should do an 8283 for the donor. The donor will require an 8283 if it's publicly traded stock. They don't necessarily require our signature, but I would make that the donor's problem. We want to be helpful. You may require an 8283. You're going to have to talk to your tax preparer. Here's that form, and I'm more than happy to work with you. Other questions?
Yes, there's one more that just popped in.
I think I answered that. If we get stock worth 6,000 or more, should we do an 8283 for the donor?
Oh, yeah. Sorry, I guess I wasn't paying close enough attention.
Nope, that's okay.
Thank you.
I'm going to move fairly quickly through the images on your screen. This is the 8283, and as I said, really seriously, not facetiously at all, take a look at this form and the instructions, because your donors are going to need help sometimes walking through this. This is the front page of the 8283. Section A is the one that gets filled out for $5,000 or less. And you can see it's just, you know, what organization, what did you give to them, and how did you figure out the value? You don't need an appraisal or anything. This slide is the second of 3 errors in this slide deck that I've found. This is actually still section A. What I meant to give you is section B, which is on the back side. This is where you're going to take a deduction for more than $5,000. And you'll see there's quite a bit more information required. And most importantly, if you go down to the bottom, deduction of over $5,000, here's where the charity is going to sign. And look at what I've boxed in red. As the charity signing it, we are saying we don't represent agreement with the claimed fair market value. It's not our business to do that. This is the reason that your acknowledgements, it's a good practice for your acknowledgements not to cite a dollar value. And I know that seems donor unfriendly, but if it is a non-cash gift, I think the best practice is for your acknowledgement to simply describe the property. Thank you for your gift of 100 shares of Facebook stock. We are going to do good work with it. Sure enough, if you say, thank you for your gift of 100 shares of Facebook stock worth, I don't know what Facebook's worth these days, $10,412, the donor is going to show up in tax court and wave your letter around and say, that's why I claimed that deduction. And that's not our business. And they will not be able to take a deduction for that amount. So I think the very best practice is for anything other than cash, the acknowledgement simply describes the property. You can add a paragraph that says you may be entitled to an income tax deduction for the average between the high and the low on the day. You can add that language if you like, but I'd be very leery of a number with a dollar sign in front of it in any acknowledgement letter other than a cash gift.
Craig, I have a quick question, and I'm
Sure.
sorry about my naivety on this, but would we ever have to fill out any of these forms for, let's say, an estate gift that we got for some reason? If somebody left you a substantial amount of money in their estate gift, I mean, and maybe their children still have some sort of ties in with it. Just wondering if that ever
Yeah,
happened.
good question. Not a naive question at all. No, probably not. Because in the case of an estate gift, although the estate will file a final income tax return, in the case of an estate gift, it's really the estate making the gift. It's sort of a separate entity. So there may be an estate tax deduction, but these all have to do with income tax deductions. So no, you probably wouldn't have to do all of this. Other questions? Okay, let's transition to, did I see something else? No. Let's transition to real estate. This begins on page 27 of your text handout. Remember, real estate's about 45% of what most people own. Those numbers are broad averages. So for example, where I live here in my corner of Minnesota, that number is probably bigger. We've got a lot of people who own farmland here, so real estate's a bigger portion of their wealth, but it's a good share of what people own. We can accept gifts of real estate. They're more complicated, and we've got to evaluate risks and rewards and make some business decisions. These are not fast decisions for us. Some of our concerns are, can we sell it? Assuming that it's not a piece of property that we covet for our mission, can we sell it, and how fast, and at what sort of price? Are there holding costs with that piece of property? You know, there could be taxes to be paid, there could be maintenance and upkeep and insurance. Even if it's a vacant lot, somebody's probably got to go mow the weeds a couple of times a year. How are we going to cover those costs? There's nothing wrong with talking to our donor very frankly about those costs and saying, you know, we're going to sell this property, we're going to do our level best. We're aware in today's market it may take a bit of time to do that. Would you consider making unrestricted contributions to help us cover those costs while we get ready to sell it? The big one for real estate is environmental liability. And this is another one of those corners that sounds harsh, but from a public policy perspective, there's good reason for this. So the general concept is, if there is an environmental hazard, an environmental problem that needs to be remediated with a piece of property, if there's that sort of a problem with property, the current owner or any previous owner, anybody who's been in the chain of title, can be held completely and solely responsible for the total cost of that liability. To a nonprofit board of directors, that sounds terrifying, because it doesn't matter whether you know about that environmental liability or not. Because you accepted that property and held it for a while, you could be responsible for all of that cleanup, whether you had anything to do with causing the problem or not. The public policy reason is, when we encounter properties like that, we really want to get it cleaned up, and we don't want to spend a lot of time hassling over who's going to pay for it. The challenge is, some unscrupulous individuals become charitable when they realize that they have an environmental liability. And they think, if I can just give this dirty property to a charity, then I can sidestep it because the charity has deeper pockets than I do. And there are different reasons to do that. There are people who use that as a strategy. There are steps we can take as an organization, and it has become really quite formalized over the last several years. One of the things we should do with virtually every piece of real estate that we consider accepting is we should have an environmental review. We should have an audit. There are professionals, engineering firms, and so forth that do environmental audits of properties, and there are standards that they follow. In general, they speak in terms of 3 different phases. So a phase 1 audit is someone with some expertise who will look at the title history of the property, and they will understand if certain kinds of businesses operated there. There could be more or less risks. They may do a drive-by or a walkthrough of the property and give you an opinion on the chances that there are risks there. A phase 1 audit will cost you, more than several $100s, but not thousands of dollars. Depending upon what you find with a phase 1, you could go on to a phase 2 audit. A phase 2 audit probably involves some sampling and a bit more study. Phase 2 audits cost thousands of dollars, but probably not tens of thousands of dollars. Depending upon what you find out there, you could go to a phase 3 audit where they're going to go out and drill test wells and all of that sort of thing. Then you're talking tens of thousands of dollars. You can do them incrementally. So if the phase 1 looks pretty good and it seems like it's a risk worth taking, you can stop there. Or maybe you want to do a phase 2 and do a little more work and decide whether you want to go all the way. A couple of things to remember about an environmental audit. One is it's just a good estimate. So the audit could be wrong. And if it is, your organization is still could still be responsible for that liability. But it gives you some sense of the risk in order to make a business decision. The other two other things from the donor's perspective, one is a question arises about who should pay for this audit. I don't equivocate about that. The environmental audit really is the charity's responsibility. And I say that for a couple of reasons. One is it's to protect our interests, the charity's interests. So this really is our cost. Second is, I always get a little nervous, no matter how trustworthy the donor is, if the donor suddenly wants to pay for the environmental audit, and then it turns out it's his brother-in-law who's going to do the environmental audit, and it all sounded good. We were going to save some money, but in the end, this environmental review is really to protect our charity's interests, and I think it's a cost of our doing business. Having said that, we want to make sure that our donor is pretty serious about this before we go to that expense. So I would not just immediately go out and start getting environmental reviews the first time somebody whispers about a gift of property. If we're pretty sure that the donor wants to make the gift, though, then it's worth that investment. The final thing is we need to make sure that our donors understand that we're going to do this, because if we do an environmental review and it does uncover something that our donor maybe didn't even know about, now it is known and they will know about it, and they will have an obligation to reveal that should we decide not to accept the property and they want to go and sell it. It could diminish the value of their property. So these are important conversations to have with our donors as we develop these gifts. Some organizations, and I think we've gotten better about it as a field, some organizations for quite a while took the position that we simply don't entertain gifts of real estate at all because of the environmental risk. I think we can be sensible about this, and there are times when it's worth the risk. Not all environmental issues mean we should not accept the gift. It is fairly common in buildings of a certain age for floor tiles to have been made with asbestos. Well, that's an environmental hazard. Easily remediated. If need be, the tiles can be removed and treated as hazardous waste. Most often they can just seal them in place. But we should know about that going into it because it's a cost that we will probably incur. Other times you do discover things underground. It turns out that there was a gas station with buried tanks that weren't treated properly. That's a major expense and we probably won't want that. In my part of the country, farm properties typically, in the period after World War II, the heating oil tanks were buried underground because nobody liked looking at the things. And most of them now have rusted out and leaked. Well, that's a $5,000, $6,000 expense. It's not insubstantial, but it's easily remediated. They can dig them up and remove the soil. So environmental review is a very important step in considering any gift of real estate. Next week, when we talk about bequests, I'll come back to this again. If we find ourselves in a position where an estate is going to give us specifically a piece of real estate, one of the first things we want to do is conduct an environmental review, because we will inherit all of that environmental liability if we accept that piece of property. Just a few other things to consider, and there's more in the text about this. If the property has debt with it, so there's an outstanding mortgage on it, it's not the end of the gift conversation, but be aware that it gets complicated very quickly. We can accept mortgaged property. What's going to happen is the donor will be liable for probably some income tax because they have been forgiven that debt. But if it makes financial sense for us, we could accept that property with the understanding that we're going to liquidate it and pay off that mortgage. It adds to the complexity, particularly for the donor's accounting. Crops and timber, we could do a whole day and a half on this. Crops and timber can be ordinary income property, or they can be a capital part of the real estate, just depending. If it's a crop that is sold to produce ordinary income, then it probably isn't part of the real estate. If it is a stand of timber that gets harvested only every 30 years or so, then it's probably a part of the capital property. Similar concerns with gifts of mineral interest. And I'll leave the details to you to read there. The last one I want to touch on is the timeshare. I have yet to see one of these work out. favorably. They are just awful gifts. They seem to make sense. And you see that guy who advertises on late night television that he can liquidate your timeshare and turn it into cash. And the problem is I've never seen that really work out. People purchased these timeshares sometimes years ago with the idea that it was going to be the family retreat, and that didn't work out. And they themselves have tried to sell it. And so all of a sudden they decide they're charitable and they'd like to give their timeshare to your organization. From a schematic point of view, it makes sense. It's a gift of a real estate interest. It's deductible at the current fair market value and you avoid the capital gains. The problem is once you accept that timeshare, you're also accepting all the liability that comes with it. And so the first thing you find out is the parking lot. Nobody tended to the parking lot for years and years. Now there's a special assessment. So now you're writing a check to the timeshare to pay for your share of the parking lot. And if it's in Florida, you know, one hurricane season comes through and suddenly the entire thing's been flattened. And now you own a timeshare in a vacant lot. So timeshares, I think, are really best to be avoided unless you have some use for it as an organization. They make sense, they pencil out fine, but they just practically are can be a real nightmare. Let me stop there and see, are there questions about real estate? So I recall in the introduction, someone is on the threshold of accepting a gift of real estate, or maybe you did.
I do have a question, and that's what do we do about people who leave us their homes in their will that we're not necessarily aware of or given many more details other than them saying, I'm leaving everything to you, including my home?
Yeah, it will depend. It's a really good question. It will depend upon the exact terms and conditions of the will. So oftentimes people will say, well, I'm leaving everything to you, including my home. What they really mean is I'm leaving my entire estate to you. If it is that straightforward, work with the executor to make sure the estate liquidates. You're better off accepting cash. And it's not, you know, we're not being in any way mercenary about this. Our business is our charitable mission. We can do that best with cash. We're not really in the business of accepting and disposing of real estate. If they've actually written into their will, I leave to you my residence at 3058 Ivory Road, then you're going to have to treat it as a gift of real estate. You're going to need to do an environmental review and decide if you're willing to accept that. If you get a chance to have the conversation with the donor in advance, point that out to them. You know, we are most interested in the work of the Humane Society, you and me, and the best way to do that is for you to make this generous gift in your will, but have your executor provide funds to us because we're not really so good at all of the rest of it. And then if you have to, point out to them that if after they're gone, it turns out that there's a problem and we're not able to accept it, our only choice is to decline that bequest. And that's not something anybody wants to have happen. So I think if you can have the conversation early, fine. If you do wind up in a position where, surprise, you now own a condominium, then you need to treat it as a regular gift of real estate, and you and your board need to evaluate the risks and the costs.
Thank you. So we could, I mean, if we don't know anything about it until the person passes and then we get the notification of it, we could decline to accept that real property.
Yes, you can. That's one of the first things we'll talk about next week. You are under no obligation to accept a bequest. And in fact, if you cannot do what the donor intended with the bequest, you're actually obliged to turn down the bequest. And I'll talk about this more next week again, but if you decline the bequest, if you disclaim, the lawyers call it, if you disclaim, your bequest then goes back into the estate and gets distributed, you know, whatever else was going on in the estate. So I don't mean that we should try to intimidate or terrify our donors, but that's a real risk. And that's part of the reason we want to talk to them about their charitable bequests. Other questions? So real estate, don't just say no, because these really can be fine gifts, but we're not going to rush into it. I guess the other thing I would say, one final caution, and maybe this is obvious. If you get a phone call, maybe you've gotten this phone call from some guy you've never heard of, who's not in your database, never showed up at any of your events, doesn't have a gift history with you, but he, by God, wants to give you the blue stucco duplex in the suburbs. Don't spend a lot of time on it. Maybe he did suddenly find philanthropy, but chances are he's probably trying to unload a problem. So I would be courteous and curious, but be very careful, because there are people who see charity, unfortunately, as a way to unload problems. So let's talk a little bit about personal property. Personal property, all the stuff. Many of the same considerations that we have with real estate. Can we sell it at a fair price? And if we need to keep it, what does it cost to maintain it? Sometimes these things are very valuable. We need to provide safekeeping for them. Do we have any particular expertise in how to handle and dispose of this property? Be very careful with personal property about reservations and restrictions that donors want to put on this, particularly in the day of emails. What did the donor say to you? Did you actually promise to keep that grandfather clock in the CEO's suite? Because that could be, under certain interpretations of state law, that could be a binding gift instrument that you just executed. So be very careful. People are sometimes very emotionally attached to these items of personal property, and they just know deep in their heart that if you used it the way they intended, the way that they always did, that it would be a fabulous gift. So be very cautious. What we want to say to donors is, look, our work, saving the children, fighting poverty, whatever our work is best done with cash that we can use for that purpose. So we want to be sure that if we accept these gifts, we'll be able to feed that need. Be careful too, I would suggest, about whether or not accepting personal property is even aligned to your organization's goals and needs. I worry sometimes when I see organizations accepting all sorts of personal property with the intention of liquidating it. It can be lucrative, it can feed your mission, but I'm not sure that you really want to become the garage sale for the region. So you can spend a lot of time on these gifts of personal property. We talked about the charitable deduction pitfalls, the ordinary income rule, ordinary income property, and the related use rule. I don't want to belabor those here. The one thing I would suggest, and it comes up more with personal property, be very cautious of the notion of a prearranged sale. This can come up particularly with collectibles. I had a donor, and I've told this story to the roundtable before, but it's true, and it's a great story. I had a donor years ago who gave to the university a collection of barbed wire. I think part of the reason this is so fascinating to me is I didn't know a darn thing about barbed wire. I just tried to avoid it most of my life. But it turns out there's a lot to know about barbed wire, and it's very individual. And when the West was young, there were all kinds of barbed wire manufacturers, and it's a cult, actually. They collect this stuff and they trade it, and this guy had this collection of barbed wire that he wanted to give to the university. And we were excited to have it because we had an agriculture program, and those guys knew about barbed wire too. I didn't. And then he said, and by the way, I've already shipped the barbed wire off to Bob in Oklahoma, and he'll be sending you a check. Oh no. Well, guess what? That's a prearranged sale, and we couldn't do that. Now, in this case, we did manage to unwind it, and he was just trying to be helpful. He knew that we really wanted cash out of it. So we did manage to unwind it. We did accept it, and we did sell it at auction. I don't think Bob in Oklahoma wound up buying it, but be careful, because donors are trying to be helpful, and they just want to be helpful, but they really can't be the ones to sell it. It has to be given to us. Then we exercise our own discretion and sell it or retain it. Questions? I'm reading a question right here. So Tina, can you speak to this? Sorry to call on you out of the blue.
No, so I just when you guys were talking about real estate, I just wanted to let you guys know that Sharing Connection is a sponsor at the symposium, and there's going to be actual sponsor booths that you can actually talk to them in real time. And Sharing Connection is a nonprofit organization who provides real estate solutions for nonprofits. So if at least get their card in case it ever comes up, because they've been very helpful to a lot of nonprofits within CPGR. So it's worth connecting with them. And there's also going to be a session sponsored by them during the symposium. I'll put the link to the agenda in the chat also, but just wanted to let you guys know that there'll be plenty of resources there at the conference.
Good. And I would suggest, particularly for smaller organizations, options like that, I do not know this particular vendor, options like that are available. There are companies and even nonprofits who will help you accept and liquidate that property. And again, if you're a small shop, you know, cash is the most important thing for your mission. So don't feel like I don't feel like that's a shortcut at all. All right, I have reached the end of our material today, and I want to give you I'm sorry, I had one note to myself, gifts in kind, and we sort of covered this with ordinary income property. Let me just say this about that. These are very valuable to our organization. We've got a lawyer who's willing to do legal work for us. Great, that's a budget saving device for us, and we should celebrate that person as a, you know, as the kind of donor that he or she is. But there's no charitable deduction for those sorts of gifts in kind. A company has some extra office space and they're willing to loan us 2 or 3 desks. That's great. That really helps our organization dramatically, but there's no deduction for a gift of space. So these sorts of gifts in kind, I would urge you to find a way to recognize them as the donors that they are, but don't lead them to believe that they can get a big tax break for doing that. Let me pause here while you think about any last questions. I would ask you to do a couple of things. First of all, I want to preview. This is what we've just been through, is about as deep as it gets. And there's a lot of detail here. I hope you've gotten the point that we don't need to be tax experts. Nobody's going to expect us to be able to cite the code. But I do think we need to be able to say to people, I think there might be a way to do that, or I think this works that way. And I'm here to help you figure out how to make the best gift that you can. I don't know a lot about this, but I've studied some of it, and let me talk to you about a gift of, you know, appreciated securities. That's the whole point of all of this. What we get into next week is really more fun, and it gets to be progressively more fun as we walk through next week. Next week, we get to talk about some of the really fantastic planned gift vehicles that really allow us to be very creative with donors. Let me see if there are questions right there. And then the other thing I would ask you to do, I know I keep interrupting myself, it's a bad habit of mine. This has been an experiment to see if we can deliver this kind of programming through this channel. If there's anything that occurs to you that we can do before next week to make it more useful, let Tina know. Everybody has her email address, because frankly, we're kind of making it up on the fly. I hope that we've delivered a pretty valid experience, but it's, you know, the platform is challenging. So if you'd like to see more of something or less of another, let us know. Or if there's something we could do differently, I'd be happy to adapt between now and then. So I don't know anybody who's ever complained about a Zoom call ending early, so that's fine too. But let me see if there are any questions before we sign off for today.
There is one from Mark at Epic Experience. If you see that.
Yeah, I see it.
Okay.
Yeah, so Mark says, and I don't know if everybody's taken the time to read it. So they get a gift in kind from a law firm, and the law firm sends them a bill, which they mention is just for their accounting. Are they possibly taking that tax deduction? First of all, because they're lawyers, I would say, okay, fine, whatever you want to do. Who knows what they're doing? They almost certainly are not taking a charitable deduction for it. They will know better than that. But they could be writing it off as some sort of marketing expenditure, client development, who knows? Who knows what's going on? I see this, oddly enough, I see this more often with law firms than others. We're going to send you an invoice, but we're going to mark it fully paid. Well, okay. We're not going to pay the invoice and we're not going to issue you a receipt. I wouldn't stop them from doing it. It's hard to tell what they're up to. Okay. Other questions? Sorry, I'm losing a thread here. Grace, you had a question about architecture firm? Oh.
Yeah, it's similar to
Yeah.
the like legal situation, but obviously it's for a capital project.
Yeah, and I think the same answer there. So an architecture firm essentially volunteers to do some sort of the design phase for your project, and they want to submit an invoice to you and mark it fully paid. Who knows why they want to do that? I would not say to them, don't send us an invoice, but they should be pretty clear that they've made a gift of services and you're not going to issue a charitable receipt. They're not going to take a charitable deduction. You can recognize them. Probably you want to put them in your donor club, however you want to arrange that.
All right. I think that's it, unless anybody has anything else. I have recorded this. I will share it. It's going to be a huge file, so I don't know how exactly that's going to happen, but I will work on it and let you all know. Thanks so much. Thanks to Craig. You know, you guys don't, I'm not sure if people realize how much work this is for him to do, but we're so appreciative. Every time we ask, he says yes. So thank you. So if that's all, I'm going to let you guys go 5 minutes early, and we will see you next Tuesday from noon to 4. Afternoon is not my best time, so that should be interesting, but I'll be here and I will look forward to seeing all of you. And then of course at the symposium on the 18th and 19th. So